Hello everyone, welcome to EduTap and welcome to today's session. So the wait is over. Today we are going to have the complete and the detailed discussion regarding the annual report of 2023-24 of the Reserve Bank of India. So good morning to everyone, welcome to the session, and today we are going to have the in-depth analysis of the annual report of the RBI, of the Reserve Bank of India. And as you know that this is one of the most important reports that is released by the Reserve Bank of India, and there are short questions that come in the examination from this report. So I hope you were waiting for this session, and now today we are going to have the analysis of it. Okay, so now before starting with the session, do subscribe to the YouTube channel of EduTap and join our Telegram channel, because the PDF of this session will be provided in the Telegram channel, and the link for the Telegram channel is provided in the description box below. So let's start with the session without any delay. Let's start with the annual report of the Reserve Bank of India. So the Reserve Bank of India released its annual report for the year 23-24 on May 30th of 2024, and the report provides the information on the Reserve Bank of India functioning through the fiscal year of the 2023-24, as well as the state of the economy, that how the economy has worked, what is the assessment of the economy and the prospects for the economy. So this all we have to discuss in today's session. Okay, so first of all, the annual report is divided into two major parts. The first part is regarding the economy, that is the review and prospects. So first we will review. The RBI has provided the review of the economy, that how the economy worked in the 2023-24, how the global economy was working, how the Indian economy was working, domestic economy was working. So the review has been provided, as well as there are the prospects that has been provided, that how the global economy, how the Indian economy is going to grow further in the coming period. Okay, so this is the idea. So this is going to be the one session, the complete session. So I hope you will be with me till the end of the session, because in this session we are going to discuss the part 1 as well as the part 2 in the complete manner. So the review has been provided, as well as the prospects has been provided by the RBI regarding the domestic and the global economy. Now coming to the part 2, it tells about the working and the operation of the Reserve Bank of India. So the RBI works in regards to the currency management, the public debt management, the monetary policy operations. So all the working and the operations of the RBI has been detailed here, that how the RBI functioned in the 2023-24 financial year and what is going to happen in the coming financial year. So a brief idea has been provided. So this is also important that we are going to discuss in today's session in brief. So these are the two parts. Now we are going to start with the first part, that is the economy, the review and prospects. So this is the part 1 that we are going to start with. In the part 1, the start is from the global economy, that what is the assessment and what is the prospects of the global economy. So the global economy, you can see that if we compare the global economy of 2022 to 2023, so for sure, in 2023, the global economy is exhibiting resilience and fortitude. The better growth, the better conditions have been seen. Not the growth, but better conditions have been seen in the 2023 as compared to the 2022. There are, however, multiple challenges that are coming up. The inflation is decreasing, but still it is still above the mark, above the required mark. So there are, however, multiple challenges that are faced by the global economy, okay, from still elevated inflation is going down, but it is still higher than the mark. Okay, in our country, let's say the inflation has gone down from 8% to 7%, but it is still higher than the 6%. Similarly, in the global economy, the inflation has gone down, but it is still higher than the marked inflation that the global economy wants. Okay, tight monetary and the financial conditions have been seen, because if there is high inflation in the global level, for sure the monetary authorities, they are going to tighten the monetary system so that there is less money supply and there is less inflation in the economy. Okay, geopolitical tensions are escalating. Before it was Russia-Ukraine war, now there is the situation in the Gaza and such. So slowly the geopolitical tensions, instead of reducing, they are expanding. There is the more and more geopolitical fragmentation that has started up. Okay, so that is another problem. So disruptions in the key global shipping routes, that has also come forward. High public debt burden has been seen, especially by the emerging market economies, and there is also the financial stability risk has come forward, due to which the resilience has been seen by the global economy, but there is still the challenges that is being faced by the global economy, and the International Monetary Fund in its report, that is the World Economic Outlook of April 2024, it has said that the global growth has actually decelerated. That means growth is happening. Global growth is happening. That is correct. But the growth is lesser than the previous year. So in 2022, the growth was at 3.5%. So the global economy was growing at 3.5%. But in 2023, the global economy has grown by 3.2%. So the global economy is growing, but at a lesser percentage. So that is the problem. And the forecast has been given, the projections have been given for the coming years also, that the world output in 2022, the world economy or the global economy has grown by 3.5%. In 2023, the global economy grew by 3.2%. That is the projection. 2024, 3.2%. 2025, the projection is that in the coming years also, the global economy is going to grow by 3.2%. Now coming to the advanced economies. In 2023, the advanced economies have grown by 1.6%. So that is a lower percent. As well as in the 2024 and 2025, the projections are that the advanced economies are going to grow by 1.7% and 1.8%. If we see for the emerging market and developing economies such as India, so we are the emerging market and developing economies, we are among this. So in 2023, cumulatively, it is expected, it is projected, it is shown that the emerging market and developing economies grow by 4.3%. For the 2024, the projection is 4.2%, and for the 2025 also the projection is 4.2%. So this is as per the World Economic Outlook growth projections that has also been specified by the Reserve Bank of India in its annual report. So these are the projections. Okay. Now the pace of economic activity was dragged down. You can see that the economic activity or the global economy was growing by 3.5%. That has come down to the growth of 3.2%. So the pace of economic activity was dragged down by restrictive monetary policy actions. That means the money supply is being reduced by the monetary authorities all around the world, especially by the advanced economies. Due to their inflation, they are having the restrictive monetary policy stances to tame the inflation, to reduce the inflation, protracted geopolitical tensions. So the geopolitical tensions, the geopolitical fragmentation is increasing, and sluggish recovery in China. So China is one of the very important economies when it comes to the growth, because the China was growing, like if we see for the last decade, the China was growing at a very high pace. But in this decade, there is the slowdown of the growth in the China, and the recovery of China is also slowing down. The potential impact of climate change became increasingly evident. So in 2023-24, so in the 2023 especially, there was the El Nino effect, the climate change effect, the weather patterns were very volatile and they were changing, due to which it affected the economy also, it affected the production activities also. Economic losses came forward because of the climate change. Okay, due to extreme weather events, there were huge economic losses that were faced in 2023. So I hope this is clear. Now moving forward, that global inflation. So we have understood about the global economy, the growth, what was the condition in the global economy. Coming to the global inflation. So global inflation fell to 6.8%. So as I've told you that the global inflation is falling. So from the 2022, the global inflation was 8.7%. That has come down in 2023 to 6.8%, but that is still very high. That is still very high as per the global economy. So global inflation fell to 6.8% in 2023 from the 6.8% in 2023 from 8.7% in 2022 on the back of easing commodity prices. Commodity prices started to reduce, the supply chain started to become better, favorable supply conditions, and monetary tightening that was done by the monetary authorities of the advanced economies and the emerging markets across the major economies, although it remained above the average of 3.5% during the 2010 to 2019. So you can understand that in the last decade, the inflation was on average 3.5%, which has increased to such high. So that's why the global economy wants the global inflation to reduce to a great extent. Okay, so this is the idea. Now, what is the prospect? So this is the assessment that what has happened in 2023, that the inflation has fallen down, but it is not very much. Okay, the fall is not very much. Now prospects. So aided by restrictive monetary policy. What is going to happen in the 2024? What is going to happen in the 2025? So aided by the restrictive monetary policy, the control in the money supply, the monetary authorities taking the control in the money supply, and lower international commodity prices, global inflation is projected to moderate further from 6.8%. It is expected to go down to 5.9% in 2024, and it is further expected to go down to 4.5% in 2025. I want you to take out your pen and copy and start making the charts here only, so that when you end the session, you have some pointers in your hand with yourself, right? So you can take out your pen and copy. If I am writing the points, you can also write the short points. So global inflation is expected to go down. So that is a good projection that has been given. So that is good for the global economy. Okay. So turning out to be, but this last disinflation means disinflation. What is the meaning of disinflation? Disinflation means that the inflation will go down. Okay. So if the inflation is 8%, it will go down to 7%, it will go down to 6%, 5%, 4%. So that means there is inflation that is happening, but the inflation rate is decreasing. Inflation, positive inflation is happening, but the inflation rate is decreasing. So this is the disinflation. So this is the disinflation. That means inflation is going to go down from 8.7% to 6.8% to 5.9% to 4.5%. So inflation will happen, but the rate of inflation will go down. So this is projected, but this last mile of disinflation is coming out to be challenging because of the changing situation of the world economy. Global merchandise trade. So now from the inflation, let's move forward to the trade. So global merchandise trade. Merchandise means the goods. So global trade in the goods volume has contracted by 1.2% in 2023 in contrast to the increase of 3% in the preceding year. So what has happened, that the global trade, okay, the global trade in the goods have decreased if we compare it by the previous year, where the goods trade grew by 3.0%. So that is something that is like problematic, but you can see that the demand is rotating towards the services now. Okay, demand is shifting towards the services from the goods, that at least the services demand is good now. So global merchandise trade volume contracted by 1.2% in 2023 in contrast to an increase of 3.0% in the preceding year in 2022. You can see as demand rotated back from the goods towards the services with the ebbing of the pandemic. As the pandemic is going down, so the production in the countries is increasing for their own domestic purposes. So the trade in the goods have gone down, but the trade in the services has increased. This is as per the Global Trade Outlook and Statistics, April 2024. That is the data released by the World Trade Organization. So you can use this points in your answer writing also. So now global trade volume. So we have seen for the goods that what is the condition for the global trade in goods. What about the global trade that is happening in the goods and services both? In the goods and services both. So the global trade volume, goods and services. So total trade that is happening in not only the goods, but the goods and services is expected to recover with a growth of 3% in 2024. 3.3% in 2025 and 0.3% from the 0.3% in 2023. So you can understand that the global trade volume that expanded by 0.3% only in 2023, that is going to recover with a growth of 3% in 2024, 3.3% in 2025. Okay, with easing inflation and the expected rebound in goods trade. If we see for the global trade volume, goods and services together, so here it only grew by 0.3% in the 2023. We are expecting it to recover very well to recover to 3% in 2024, 3.3% 2025 and 3 from the 0.3% in 2023. So expected pickup in the global trade in 2024-25 will however pale relative to the 4.9% of the expansion that was achieved during the 2000 to 2019. So in the 2000 to 2019, the global trade that was happening was expanding by the average of 4.9%. So even the 3.3% of the trade growth is not as good, that you can understand. Okay. Global trade in the goods and services. So that was 0.3%. That was growing by only 0.3% in 2023. That is expected to grow by 3% in 2024. That is further expected to grow by 3.3% in 2025. So I hope you have understood this now. So sovereign bond yields hardened to multi-year highs. So what was happening that in the 2022, the sovereign bond yields, that is the government bonds, all over the world, the government bond yield was decreasing. But now it has increased to multi-year highs in the first half of the 2023-24. So this is something good, but this has come because of the increase in the repo rates, because of the increase in the rates by the monetary authorities. Okay, so sovereign bond yields hardened to multi-year highs in the first half of the 2023-24, driven up by the monetary tightening that happened and exhibited large two-way fluctuations that happened in the later part. Okay, so what is the situation here? Let me explain you that the sovereign bond yield. So our government also releases the government securities, right? So for the 2023-24, for the first half of this financial year, the yield of the sovereign bonds was to a multi-year high because of the high interest rate. So when the interest rate is high, the yields are also high in the market, right? So that's why the sovereign bond yields were also at the multi-year high in the first half of 2023-24. But in the later half of 2023-24, there was the fluctuations that were coming in the yield of the sovereign bonds. So that is all that is presented here. Okay. So I hope this is clear. Let's move forward with the domestic economy. That what is happening to the domestic economy? We can all see that our economy is quite resilient. Okay. So the Indian economy is exhibiting great resilience and stability. We are the fastest growing major economy. So India has emerged as the fastest growing major economy in the world. Okay. Fiscal consolidation is progressing. Fiscal consolidation means that our government is focusing now on reducing the fiscal deficit. So we'll understand that what is the fiscal deficit and such, but you can understand that our government is focusing on reducing the borrowing requirements, reducing the deficit of the government. Okay, so fiscal consolidation is progressing along with an improvement in the quality of the fiscal spending, where we are focusing on spending more on the capital expenditure. Okay. Next, financial sector is sound and vibrant. So there is less volatility in our financial sector. So there is huge volatility that is coming in the financial sectors of the other countries, but our financial market is quite stable. Double-digit credit growth has been seen in our country, backed by the high capital adequacy and the solid earnings and improvement in the asset quality. So NPAs are reducing, simply asset quality is improving means the non-performing assets are reducing, our capital adequacy, the CRAR, the capital to risk weighted asset ratio, or the adequate capital that is being maintained by the banks are also very good, and the credit growth is also happening. So credit growth is happening, NPAs are reducing, we are maintaining good capital. So this is the whole understanding here, that all the sectors of our country are doing good. Now coming to the point, yes, World Economic Outlook has been mentioned. If I have brought some data now, I have brought it directly. All the data points, they are directly from the annual report. So if I am mentioning a particular report, so RBI has mentioned that particular report in its annual report. So remember that. Okay. Now Indian economy expanded at the robust pace. So now we have come to the domestic economy. Let's see the assessment of the of the domestic economy. The assessment of the domestic economy, we are starting with the assessment and prospects of the global economy. Are they clear? Any confusion in that? So I hope, is it clear, the previous slides? Now the Indian economy has expanded at a robust pace in 2023-24 with real GDP growth increasing to 7.6% from the 7% in the previous financial year. Okay, so now this is the data point that is as per the second advanced estimates. Okay, this is the data point that is given in the RBI annual report as per the second advanced estimates of the NSO that were released in February 2024. But recently in May 2024, the NSO has released its provisional estimates. The NSO has released its provisional estimates. As per the provisional estimates, that our economy has grown from 7.0% to in the previous financial year 2022-23 to the 8.2% in 2023-24. So that is, as per the second advanced estimates, the data was that our economy has grown by 7.6% in the 2023-24. But as per the provisional estimates that have been recently released by the National Statistical Office, as per the provisional estimates, as per the most recent estimates of the NSO, our economy has actually grown by 8.2%. So that is the estimate. So that's why we will not focus on the previous estimates, because the new estimates have been released. Okay. Here with the previous estimates, with the previous estimates in the annual report, it has been mentioned that the gross fixed capital formation. Gross fixed capital formation means that this is the investment that has happened in the fixed assets such as the buildings have been made, factories have been made, houses have been made. There is the machinery, the huge machineries that have been bought. So they are the fixed assets. So gross fixed capital formation has grown in our country by 10.2%. It has accelerated. It has grown by 10.2% in 2023-24 from the 6.6% in the 2022-23. Investment was the major driver of the domestic demand. So you can see that the investment was the major handholder of the increase in demand in our country. Government spending on infrastructure, so it was even higher than the government spending on infrastructure. Okay, the government spending, so the private investment was also happening very much, as well as the public investment. The government spending on the infrastructure was also very high in 2023-24. Growth in private consumption demand, on the other hand, stood at 3%. So the consumption demand was also increasing, but it was increasing only by 3% as compared to 6.8% a year ago. And all of this data point is as per the second advanced estimates of the NSO. Okay. Now coming to the next point, that the government consumption demand. So government investment demand is increasing. The government investment demand is good. It has been good in the previous year, but the government's consumption demand was subdued, tracking fiscal consolidation. So the private consumption demand has also gone down of the households, as well as the government's consumption demand has also gone down because of the promise of the fiscal consolidation, that now we will focus on reducing our fiscal deficit. Okay. Net exports dragged down growth due to the moderation in the exports. So net exports, so aggregate demand is what? It is consumption plus investment plus government expenditure plus net exports So our consumption is growing, but it is growing by a lesser percentage, that is only 3%. The investment is growing very rapidly, both the government investment as well as the investment done by the private sector. The government consumption expenditure has actually the government consumption expenditure has dragged down, it has subdued, so it might be increasing but not as much. Okay. Similarly, the net exports have actually gone down. Okay, the net exports dragged down the growth due to the moderation in the exports as a result of contraction in the global trade volumes. So the global trade volumes have gone down, the exports of our country has also gone down. So global trade has gone down, so of course our exports from our country are also going down. So import demand was relatively buoyant because of the demand, the growth in the demand in our country. Okay, so we were importing good. On the supply side, the growth in gross value added. So this is till now, this is from the demand side, this is from the expenditure side. Now let's see from the production side. So as per the supply side, the growth in gross value added in the agriculture and allied sector in 2023-24 stood at 0.7%. So growth that has happened in the agriculture and allied sector. So now this is the data point. This is as per the second advanced estimates of the GVA, that the growth in the agriculture and allied sector, the growth has happened by 0.7%. If you see the data point for the provisional estimates, so that has been recently released. So as per that, the agriculture, livestock, forestry, so agriculture and allied sector has grown by actually 1.4%. 1.4%. That is actually double than the second advanced estimate. So there is a difference. So this is the more recent data, but this is the data that has been presented in the annual report. Okay. So on the supply side, growth in the gross value added in the agriculture and allied sector in 2023-24 stood at 0.7% as against 4.7% a year ago. As food grains production declined, the food grain production has declined, the deficiency and uneven southwest monsoon rainfall. So weather patterns are changing. As I've told you, climate change is becoming a problem, and that's why the food grain production has declined. And you can see that's why the agriculture and allied sector that was growing by 4.7% in the previous year has grown by 0.7% only in this year, in this financial year of 2023-24. Now the government continued with initiatives to promote. So this is till now we have seen the assessment of the domestic economy. Now the government continued with the initiatives to promote the industrial sector. The government has brought different schemes, Muft Bijli Yojana and such. So you can see that initiatives have been brought by the government to promote the industrial sector, especially in emerging areas. So in the semiconductor area, the government is especially focusing on. So the investment amounting to rupees 1.3 trillions was approved for the establishment of 3 semiconductor manufacturing units as part of the development of the full production line for the semiconductors, so that we can produce the semiconductors in our country rather than importing them in huge amounts. If you see the employment data, the employment conditions have improved and the unemployment rate is falling to its lowest levels during the 2023, that is from January 2023 to December 2023. 3.1% in the usual. So usual status unemployment means that is for the 1 year. If we see in the 1 year period, that is in the 365 days period, so the unemployment that is seen for the 1 year time period, so that is taken under the usual status unemployment. Okay, so usual status unemployment is 3.1% in the usual status and 5% in the current weekly status. So current weekly status, in the weekly status you can understand that in the week the reference period is the week. So in the usual status the reference period is 1 year. In the current weekly status the reference period is 1 week. Okay, in the periodic labor force survey, so in the PLFS data that has been seen, so the unemployment rate is 3.1% in usual status and 5% in the current weekly status, but the unemployment rate is actually falling down. Okay, both urban and rural regions recorded a decline in the unemployment rate. So the labor force participation rate has also increased and the worker population ratio, so that is 50. So labor force participation rate is 59.8% and the worker population ratio is 58% respectively. So in 2023, the highest since the survey's inception. So survey started from 2017 approximately. So from 2017-18 the survey, the PLFS survey has started. From then it is the highest of the labor force participation rate has been seen and the highest of the worker population ratio has been seen. So worker to population ratio is worker population ratio and labor force participation rate is highest since the 2017 to 2018, that you can understand. Okay, with a steep rise, with a huge rise in the female labor force participation rate. So the females are participating in the labor force, so that has also increased. Understood? Is any confusion here? So I hope you have understood the terms in your static also. I have given you brief idea. Usual status is for 1 year. The reference period is taken and it is seen that what is the unemployment rate in the 1 year time period. The current weekly status that is seen for the week reference period are taken as the weekly. Okay. Then labor force participation rate, that what is the participation in the labor force. Labor force is the total people that are willing to do the work. So that is labor force is your unemployed people and the employed people. So that is your total labor force. So labor force participation rate and the worker population rate is at the highest levels from the 2017 to 2018. So this is the data points that you can use in your answer writing if there is any question regarding the domestic economy. Now, according to the Climate Change Performance Index Report 2024, India's climate action performance has been very good. It has improved, making India the 4th best performing nation among the 63 countries that have been analyzed. So this we have discussed in depth. Gurkira sir has also discussed this index with you. So I hope you know about this index, but this is the data point that you can remember. Headline inflation. Now till now we have discussed about the growth, about the production, about the unemployment, but now let's focus on the inflation. Okay. Headline inflation, that is the retail inflation, that is the CPI inflation, we can say it has softened to 5.4% during the 2023-24. So remember that whenever the GDP data comes now, the GDP data is the projections that have come. Okay, the provisional, the advanced estimates and such. So first advanced estimates are released, then the second advanced estimates, then the provisional estimates. So GDP data is projected. is expected, is estimated data. But the headline inflation, this is the actual data that has been shown. So headline inflation has gone down, softened to average of 5.4% during 2023-24 from the 6.7% in the previous year. So at least 5.4% that has been achieved in the 2023-24. This is lower than the 6% of the upper tolerance band. We have the inflation targeting that we have is 4% plus minus 2%. So that is 6% is the upper tolerance level. The inflation should not increase more than 6%. So at least the inflation, the headline inflation has come to the 5.4%, that is lesser than 6%. Now why this has happened, how the inflation has reduced, so let's see that. So first of all, the core inflation, that is the inflation that is excluding the food and fuel prices, because food and fuel prices are very volatile. So CPI inflation, the core inflation is actually the inflation that is excluding the volatile prices to actually see the condition in the economy. Okay, so core inflation, that is the CPI inflation excluding the food and fuel, has actually fallen down to 4.3% from the 6.1% due to the softening in the prices of both goods and services. Okay, fuel inflation also has eased sharply, and the most important point is the fuel inflation has seen the deflation. So there is the deflation that has happened. What is the meaning of deflation? Deflation means negative inflation. So this inflation means inflation is positive, but it is going down. The percentage is reducing. In the deflation, the inflation is negative. That means the prices are reducing. So here you can see that in the fuel inflation, the deflation has come. The deflation has come means since September 2023, not from the starting, but from September 2023, there is the deflation that has started. So deflation means that the fuel inflation has started to reduce, or there is the prices, not inflation, but the prices, the price level in the fuel has started to go down. Okay, since September 2023, with the reduction in the domestic prices of the LPG and kerosene on the back of correction in the global energy prices. So understood? Yes, very good. So food inflation, now this is regarding the fuel. Core inflation has gone down. Fuel inflation, since September 2023, it has seen the deflation, that actually the prices are reducing. Okay, food inflation is the main problem here. So food inflation, on the other hand, hardened, has increased amidst the high volatility because of the 2023-24. There were the climate change effects, there were the El Nino effects, due to which the food production was very volatile. Okay, so high volatility has been seen in the food inflation. Sustained pressures from prices of cereals, pulses, spices, vegetables due to overlapping supply shocks pushed up the food inflation to 7% in 2023-24. So this is the average, 7% in 2023-24 from the 6.7% a year ago, thereby keeping the headline inflation above the target. Otherwise, if you see the core inflation, that is usually the manufacturing prices and such, so that has gone down. The inflation has gone down in the core inflation, as well as the fuel prices have gone down. There is actually deflation in the fuel prices. The actual problem is coming from the food inflation. Okay, now one more interesting thing here is that the food inflation contribution in the contribution of food and beverage inflation was highest in the CPI inflation. So inflation in food and beverages remained the major driver of the headline inflation that we have understood. Actually 60.3% of the headline inflation was contributed by the food and beverage inflation. That is higher than the 46% a year ago. So the contribution to headline inflation increased, the contribution of the food and beverages in the headline inflation increased to 60.3% during 2023-24 from the 46% a year ago. And if you see for the fuel group, actually their contribution has decreased immensely. So the contribution of the fuel group to the headline inflation has decreased to 1.6% in 2023-24 from 10.5% a year ago. So one thing that I want to mention here, do not focus on remembering the data for now, because this data is good for understanding. This data you do not have to remember from exam point of view. So I will tell you that which data to remember which data to not focus on. So for now, just focus on understanding, not that itna sara data kaise hoga, how to do this and that. So right now, just focus on understanding. I will tell you that how and which data is important. Okay. Now here you can see that the contribution, During 2023-24, the CPI headline inflation was primarily driven by the prices of food and beverages, followed by the health and education, housing and clothing, and the footwear. So you can see 60.3% contribution was done by the CPI inflation in the CPI inflation by the food and beverages as compared to the 46% in the previous year. While if you see of the fuel prices, if you see for the fuel prices, the contribution was 10.5% in the previous year, which has declined to only 1.6. You can see how less it has become, 1.6% in the 2023-24. So the fuel prices are actually pulling down the inflation in our country for now. This data you do not have to remember. This is for your understanding that the highest share in the inflation is of food and beverages. The inflation in food and beverages hovered in a wide range of 3.3% to 10.6% in 2023-24. That means food and beverages have gone as low as 3.3% and as high as 10.6% in the 2023-24. Housing inflation has moderated. It has come down from 4.9% to 2.7% in the financial year. Inflation in personal care and effects increased marginally to 7.8% from the 7.6%. Inflation in the fuel and light group averaged to 1.2% during the 2023-24. That was lower than the 10.3%. Now you will say that the fuel prices are actually having the deflation, right? So how it is a positive inflation that is showing? So remember that the fuel inflation or the fuel prices were having the deflation since September 2023. That means from April 2023 to September 2023, there was actually the inflation in the fuel prices. So if you take the average of the full financial year, then you will get this minimum of the fuel inflation that was during the 2023-24. So I hope till now it is clear. So now furthering the idea, liquidity conditions have tightened because there was surplus liquidity. During the COVID, what happened? During the COVID, there was free ration that was given, there was high subsidies that were given, and there was much of the expenditure that the government was doing for the healthcare services for the benefit of the people, right? So at that time, the government had to do immense expenditure, due to which the money supply increased in the economy. Now this high money supply increases the demand in the economy, which increases the prices in our economy. So the inflation became the problem. Now to reduce the inflation, we have to decrease the money supply. So the RBI is tightening the liquidity conditions in the economy. Okay. During the 2023-24, in sync with the monetary policy stance that we are withdrawing the accommodation, we are looking after strict control in the inflation. We want our inflation to be around 4%, not around 6%, around 4% we want our inflation. So that's why the liquidity conditions have to be tightened. Okay, liquidity surplus as reflected in average daily net absorption. So liquidity surplus was being absorbed. So that was, if you see in the previous year, the absorption on the daily level was happening of rupees 1.87 lakh crore, which has gone down in 2023 to 2024 to the rupees 485 crore of the daily net absorption. So daily net absorption has gone down from the 2022-23 to 2023-24. So in the 2022-23 also, in the financial year 23, there was the daily net absorption that was happening of the money supply of rupees 1.87 lakh crore, which has gone down. Daily net absorption in the 2023-24 was only 485 crores of the net absorption, because already in 2022-23 there was a lot of absorption that has already happened. Okay, so this data point, you just have to understand that the absorption, daily net absorption is still happening, but it is lower than the previous year, because in the previous year already, in the previous financial year already, there is much of the absorption that has happened. Now the INR depreciated during the 2023-24 by 1.4%. So that is bad. Our currency is depreciating. But if you see the data of the previous year, in the previous financial year of 2022-23, the INR depreciated by 7.8%. So this data point will seem very good right now, right? So the INR depreciated by only 1.4% during the 23-24 as compared to the 7.8% of the previous year. And India was amongst the best performing major emerging market economy currencies during the year. So you can understand that we were actually performing good, even if the depreciation is happening, that is actually good. So now the domestic, I will take your query at the end of the session, Muskan, now, okay, because going back will take a lot of time. So domestic equity market capitalization crossed the US $4 trillion mark. So that is also good. First of all, the market capitalization means that the market price multiplied. So let's say the market price of Reliance Industry shares. So Reliance Industry shares per share, one share is of 10 rupees. And Reliance Industry has in total 100 shares. So the market capitalization of Reliance Industry will be 1000 rupees, because market price of one share is 10 rupees. In total, Reliance Industry has 100 shares in the market. So in total, the market capitalization or the market value, we can say, of the Reliance Industry is 1000 rupees. So the market capitalization of a company is the product of its current market, is the multiplication of the current market price of the share multiplied by the total shares that have been released in the market. Similarly, if we talk about the equity market capitalization, that means the total share market value, that is US $4 trillion. That means all the shares in our market multiplied by the value of all the shares in our market. So that is nearly US $4 trillion. So that is huge. Okay. So domestic equity market capitalization crossed the US $4 trillion mark in the second half of 2023-24, making the Indian stock market the fifth largest in the world. So this is again a very big statement that you can remember, that the Indian stock market has reached to the fifth largest in the world. Now coming to the next point, India's merchandise exports fell. So as I have told you that the exports of our country were falling down. Okay. So India's merchandise exports, India's goods exports fell in 2023-24, driven by the decline in the global trade volume and commodity prices. So in 2023-24, the merchandise exports contracted by has gone down the 3.1% in the US dollar terms, while the imports fell by 5.7%. So here we are talking about the actual fall that has happened. Okay. So the exports have contracted by 3.1% and the imports have fell by 5.7%. So the exports have fell by 3.1% and the imports have fallen by 5.7%. So consequently, India's merchandise trade deficit narrowed to US $238. So here you can see that our exports are also falling, the imports are also falling, right? But you can see that the exports are falling more as compared to the imports are falling more as compared to the exports. So the exports are falling down by 3.1% while the imports are falling down by 5.7%. So that means the imports are falling more as compared to the exports. So that is a good point, because due to this, the mercantile trade deficit has narrowed to, has gone down. The deficit has gone down to US dollar, to only US dollar 238.3 billions during the 2023-24 from the US dollar 264.9 billion a year ago. So the deficit has gone down from the 264.9 billion dollars to 238.3 billion dollars, because the decrease in the imports was higher than the decrease in the exports. Both have decreased, but the imports have decreased more as compared to the exports. Okay, a steady flow of inward remittances were seen. So a steady flow of inward remittances were coming in from our brothers, sisters, the people that are living in America, they are living in Singapore, they are living in UK, US, in different countries. They are sending the remittances to our country, to the relatives of theirs, right? So inward remittances flow has been steady. The current account deficit moderated to 1.2% of GDP. So here you can see that the data point is that the trade, mercantile trade has decreased, the exports have decreased, the imports have decreased even further, due to which the mercantile trade deficit is happening, but the deficit is lower than the previous level. There is the steady inflow that is happening of the remittances, so that is good. Okay, so here with robust services exports, the services exports have also been robust. They have also been good from our country. So we are doing good services exports. So our services exports are good. The steady flow of inward remittances are coming, that is actually able to cover some of the deficit in the trade account. Okay, in the goods trade account. So the deficit, the current account deficit. Okay, what is current account? The current account in the balance of payment. Now this consists of the trade in goods the trade in services, and the transfer payments. Okay, that is unilateral payments. So trade in goods, here we are having the deficit in the trade in goods, in the merchandise trade. Trade in services is robust. There is the steady flow of remittances that are coming in. So you can understand that these two are good. The trade in services is also robust, and as well as the transfer payments are also steady, are also good. Only the high deficit is in the trade in goods, but the deficit has also actually gone down. So the current account deficit. So in total, the current account is in deficit situation, but the deficit has reduced from 2.6% of the GDP to 1.2% of the GDP. So that is, the current account deficit has gone from 2.6% of the GDP in the April to December 2023 to 1.2% of the GDP in April to December. So from the April to December 2022, where the current account deficit was 2.6% in the corresponding period in the previous year, it has gone down to 1.2% of the GDP during April to December 2023. Any confusion here? Any confusion? Is it clear? The idea is clear? So the current account deficit is happening, but that is a lesser percentage of the GDP, so that is good for our country, that at least our deficit is contracting, okay, which was 2.6% in the previous year in the corresponding period of April to December 2022, which has gone down to 1.2% of the GDP during April to December 2023. Now we have discussed about the current account. What is the capital account? In the capital account of the balance of payment, we have the liabilities and the assets. So the investment that comes under the capital account, the external commercial borrowings or the commercial borrowings that also come under the capital account, as well as the external assistance also comes under the capital account. So if the foreign direct investment is happening, if the foreign portfolio investment is happening, that is all coming under the capital account. Okay, that is all coming under the capital account. So net foreign portfolio investment. Net foreign portfolio investment means portfolio investment is coming into our country. Whenever there is a term net now, always remember that the money is coming into our country. The dollars are coming into our country, minus the dollars are going out of our country. So foreign portfolio investment is happening in our country. The money is coming into our country. Foreign portfolio investment is coming into our country, as well as we are also doing some foreign portfolio investment in other countries. We are also investing in US stocks, in the UK stocks and such. So foreign net means that foreign portfolio investment is coming into our country, minus it is going out of. Foreign portfolio investment is done by the Indian investors in the outside market also. Okay, so net foreign portfolio investment coming in minus coming out recorded a significant turnaround of US dollar 41.6 billion in 2023-24. So actually this has net FPI has remained in positive. That means more of the inflow has happened as compared to the outflow, and the net FPI has remained at $41.6 billion in 2023-24, a second highest after the 2014-2015, where the net inflow of the foreign portfolio investment was 45.1 billion. India received the highest net FPI inflows amongst the emerging market economy peers during the year. So that you can understand, we have understood the situation of the current account. We have understood the situation in the current account, that the current account, there is the deficit in the current account, but the deficit has narrowed, has come down from the 2.6% of the GDP to the 1.2% of the GDP in the given period. In the current account, we are starting with the net FPI. In the capital account, we are starting with the net FPI. So the net FPI has, you can see it is the second highest since 2014 to 2015. Gross foreign direct investment. Now coming to the foreign direct investment. So when we talk about the foreign direct investment, so the gross, that means total foreign direct investment that has come into our country. So total foreign direct investment that has come into our country, so that is resilient at US dollar 71 billions dollars in 2023-24 as compared to the $71.4 billion in the previous year. So yes, there is a $0.4 billion of the decrease in the gross FDI, but that is fine. It is comparable as the previous year. Now, what is the problem that has come? That we have done too much of the outflow. We have done too much of the outflow. The inflow is as same as the previous year. So it is $71.0 billions of the FDI inflow that has happened. So the gross inflow is $71 0.0 billions. But if we see the net means what has come in minus what has gone out. So the FDI that has been done by the Indian investors in the other countries, it is huge, due to which net FDI has decreased from the previous level. Okay, so that data point we are going to see in the coming slides also. So this is the idea mainly. Okay, so the net FDI flows, as I have told you, that there is the FDI that has come in, but there is huge FDI that has gone out. Due to this, net FDI is still positive, but it is lower than the previous year. It is lower than the previous year. So net FDI flows, however, moderated or decreased to US dollar 10.6 billion from the US dollar 28 billion, primarily owing to the higher investment that we have done to the other countries. So that means in the previous year, the net FDI flows was US dollar 28 billion. In this year, in this financial year, the US dollar 10 billion. So in the previous year, this was the net FDI inflow. In this year, in this financial year, this is the net FDI inflow. That is for sure $18 billion lower. But this is mainly because of the more FDI that we have done in the other countries. So now with overall net capital inflow. So net capital inflow has happened because you can see that net FPI inflow is US dollar 41.6 billion. Net FDI inflow is US dollar 10 point something billion. Okay, so there is the overall net capital inflows that has outpaced the CAD, that is the current account deficit. So this net inflow has outpaced the current account deficit. So the capital account has totally covered the current account deficit. So in the capital account, there is the inflows, there is the surplus that has happened, that has outpaced the deficit in the current account. There was an accretion, and we have actually accumulated the extra foreign exchange reserves to the tune of US dollar 32.9 billions, okay, during the April to December 2023. So if we see for the recent period, for the May 17, 2024, the India's foreign exchange reserves have rose to the all-time high of US dollar 648.7. Okay, now India's foreign exchange reserves. So you can read this data point. This is just to give you the idea that at the end of March 2023, what was the position of the foreign exchange reserves. So here, the understanding I have provided you, here only the data point is given for the March foreign exchange reserves, okay, but this is the recent foreign exchange reserves, so this is more important data point. Okay, now as at the end of March 2024, the foreign exchange reserves provided a cover of 11.4 months of imports for the 2023-24. So that is a very good time period that we can cover our imports without earning anything. We can still cover our imports for 11.4 months with the foreign exchange reserves that we have at the end of March 2024. In 2023-24, the total, now we have moved forward. We have understood about the current account. We have understood about the capital account. The current account deficit is being covered by the capital account surplus that has happened, and the capital account surplus is even higher, that is adding to the foreign exchange reserves. In 2023-24, total digital payments recorded growth of 44.3% and 16.4% in the volume and value. So in volume, the growth is of 44.3%. In value, the growth is of 16.4%. On top of the growth of 58.3% and 19.7% in the previous year. So in the previous year, there was growth in the volume and value of the total digital payments. Above than that growth means in the previous year also there was the growth that happened. In this year also the growth that has happened. So you can understand that continuously there is growth that is happening in the digital payments. So UPI platform achieved significant milestone, surpassing 13 billion transactions in a single month in March 2024. So this is a milestone that in a single month we have surpassed 13 billion transactions in the March 2024 in a single month. So now this is the assessment of the 2023-24. So now we will see that what is the prospect of the domestic economy in the 2024-25. Any confusion till now? So real GDP growth as per the second advanced estimates released by the NSO for the 2023-24, there was the data that was given that our economy has grown by 7.2% in 2023-24. I hope 7.6%, sorry. in 2023-24, but the provisional estimate said that our economy in 2023-24 has grown by 8.2%. Now, if we see for the 2024-25, now we are starting with the 2024-25. So, real GDP growth as per the Reserve Bank of India, the real GDP growth for 2024-25 is projected at 7% with risk evenly balanced. So, this is the projection that has been given for the real GDP growth of 24-25. Till now, we were discussing about 23-24. CPI inflation for 24-25 is projected at 4.5%. So, CPI inflation is projected to go down in the 24-25 to at the 4.5% with risk evenly balanced. The digitalization of the tax system. So, the tax system has been digitalized. You have to fill the ITR, you have to fill the income tax returns. You can just fill it sitting at your home, right? So, digitalization of the tax system has enhanced the tax collections with the center's direct tax revenues budgeted to reach 6.7% of the GDP. So, the direct tax revenues are budgeted to reach 6.7% of the GDP in 2024-25, the highest in the 3 decades, in the highest in the 30 years. India's share in the world remittance receipts is estimated to increase to 15.2% in 2024 and from the 11.1% in 2019 according to the data presented by the World Bank, and that is mentioned in the RBI's report. So, the India's share in the world remittance receipts is going to further increase to 15.2%. The central government extended the financial assistance scheme for the state's capital expenditure to the 24-25 with an outlay of rupees 1.3 lakh crore. So, it is said by the center that we are going to provide the financial assistance for the states capital expenditure so that they can build the assets in their states, and this is the total outlay that is going to be provided to them. Okay, the budgeted reduction in gross market borrowings. So there is the two terms that you have to understand. One is the gross market borrowings. So this is the total market borrowing that is being done by the central government in a financial year. Okay, now from this you have to, so gross market borrowings is, let's say, rupees 1000. From this rupees 1000, let's say the government has used rupees 100 to repay the past loans. So in 2023-24, the government has done the gross market borrowings of rupees 1000 in the 2023-24 financial year. From this, rupees 100 has been used to repay the previous loans. So how much is left with the government to use? Can you tell me that what is left with the government to use? So what is left with the government to use? So that is rupees 900. So that is the net market borrowings. That is the net market borrowings. So understood? Gross market borrowings is the total borrowings that has happened in the financial year. From that you have to deduct the repayment of the loans that has been done from using this money, the borrowed money, and whatever is left is the net market borrowing that the government can actually use for its expenditure. I hope this is clear. So here the budgeted reduction in the gross market borrowings from 5.3% of the GDP in 2023-24 to the 4.3% of the GDP in 2024-25. So it is like said by the government that we are going to reduce the gross market borrowings because the government is doing the fiscal consolidation. The government has to reduce its deficit. The government has to reduce its borrowing. Okay. So the government has said that the budgeted reduction in gross market borrowings from 5.3% of the GDP. So gross market borrowings was 5.3% of the GDP in 2023-24, which the government has said that we will reduce to 4.3% of the GDP in 2024-25. This is the budgeted estimate as per the budget. Will enhance the flow of funds to the private sector. So more fund will be left in the country for the private sector to take in the loans, and the private sector can do more investment with the rest of the money, supporting the private investment. Net market borrowings for the 2024-25 budget estimate are placed at 11.75 lakh crore, that is 3.6% of the GDP. So out of the 4.3% of the GDP, that is the gross market borrowings, from out of that 3.6% of the GDP will be left as the net market borrowing that the government can actually use for the expenditure. Okay, as compared to the 4.0% of the GDP that was the net market borrowings in the previous financial year of 23-24. Clear? Now coming to the prospects for the sovereign regulatory. So this is the last slide for the prospects. After that we will be moving forward with the next part. Okay. several regulatory and supervisory measures will be undertaken. So here you can see that the different supervisory and the regulatory measures were taken by the Reserve Bank of India. Reserve Bank of India said that in 2024-25 we are going to expand the scope of ongoing pilots in the e-rupee retail. E-rupee is the central bank digital currency that instead of having the notes with yourself, you can have the digital rupee with yourself, right? So the RBI is saying that we are going to expand the pilots for the e-rupee retail segment and e-rupee wholesale segment in the 2024-25. We are going to expand the PCA framework, the Prompt Corrective Action Framework, to the urban cooperative banks. So urban cooperative banks are revised supervisory action framework under the nomenclature PCA framework is under consideration that the RBI is thinking to bring for the UCBs. So when it will come, I will take the full session, but this is what the RBI is going to do in the coming years. In the coming year, that is 2024-25. So that is the prospect. So several regulatory and supervisory measures will be taken by the Reserve Bank of India for its to strengthen the financial intermediaries such as the banking institutions, the NBFCs and such. During 2024-25, the RBI would also review the priority sector lending guidelines. So major changes can be brought by the Reserve Bank of India. RBI has said that the priority sector lending guidelines will be reviewed and work towards formulation of the next NSFI. So NSFI, that was for the period of 2019 to 2024. So this NSFI is going to end soon. So the new NSFI will be brought. So RBI is saying that we are going to focus on the formulation of the next iteration of the National Strategy for Financial Inclusion. So in which the strategy is written that how we have to do the financial inclusion. So there is the next iteration that is in process, we can say. For ensuring public confidence in the financial system and to protect the interest of the customers in the regulatory enterprises, it is said by the Reserve Bank of India that the RBI will focus on embedding the AI and other related tools in complaint management system to facilitate lodging of complaints with ease. So even greater consistency to achieve greater ease for the customers, the RBI is saying that in the complaint mechanism, there will be the AI tools that will be used to further smoothen the process for the customers. So till now we have understood, in the part 1 we have understood the first part. Now we will focus on the economic review. So most of the parts of this has already been done. We have discussed the real economy, we have discussed the inflation situation, the external sector. So now this economic review will become very smooth for you. We just have to revise many of the things and this will be the second part. So now, as you can see, starting with the economy, the real economy. So as per the second advanced estimates, there was the data that was released that as per the second advanced estimates in 2023-24, the economy has grown by 7.6%. Okay, 7.6%. And it was said, so the GDP, real GDP growth is 7.6%. And for the GVA, it was said that the GVA at basic prices, it has grown by 6.9% in 2023-24. But as per the provisional estimates, so these provisional estimates, they are not present in the annual report, but I have brought this for you so that you have the clarity that as per the annual report, this is the data point that has been presented by the Reserve Bank of India as per the second advanced estimates. But after the second advanced estimates, the provisional estimates are released. So this is as per the provisional estimates. So real GDP has been estimated to grow by 8.2%. So in the second advanced estimate, 7.6% was said, but it is actually 8.2% as per the provisional estimates. Okay. Now, real GVA has grown by 7.2% in 2023-24. So real GVA, it was said in the second advanced estimates that the real GVA has grown by 6.9%. So it is not 6.9%, it is actually 7.2% as per the provisional estimates. So real GVA has grown by 7.2% in 2023-24. over the 6.7% in 2022-23. Understood? So this is the difference that you can read. I have just brought it for you so that you have the clarity that what the second advanced estimate said, what the new estimates, that is the provisional estimates, what are they saying. And this is the new estimates. Now, this was the data point that was presented by the second advanced estimates. This is the data point that is presented by the provisional estimates, that are the recent ones. So second advanced estimates were released in February 2024. Provisional estimates are released in May 2024. Okay, so as you can see that as per the second advanced estimates, the GVA at basic prices grew in 2023-24 by 6.9%. But if you see that the GVA at basic prices as per the provisional estimates, they have grown by 7.2%. 7.2%. Okay. So this is the difference. Now coming to the inflation, we have already discussed about the inflation, that the headline CPI inflation moderated in 2023-24 from the 2022-23. The core inflation is the one that has exhibited a broad-based disinflation since June 2023 and moved below 4% by the end of 2023. So this is not the average, this is the main data point that the 4%, below 4% core inflation was achieved by the end of 2023. But if you see the average for the core inflation, that was 4.3% for the 2023-24. Headline inflation softened to 5.4% during the 2023-24 from 6.7% from the previous year. So I hope you remember this data. We discussed this data in the starting, in the assessment of the domestic economy. The core inflation decreased to fall to 4.3% from 6.1% in the 2023-24. Okay, and by the end of 2023, the core inflation even moved below 4%. But if we see the average for the whole financial year 23-24, it was 4.3%. Now coming to the money supply. So this is what we have to discuss now. So here the money supply. So reserve money, if we see the money supply, that is M3. M3 is taken as the money supply. So there are different measures of money supply, M1, M2, M3, M4. M3 is taken as money supply in our country. So Reserve Bank's balance sheet size has increased to 24.1% of GDP at the end of March 2024 from 23.5% at the end of March 2023. So this is also because of the money supply. M3 recorded a growth of 11.2% as on March 22, 2024 as compared to the 9% in the previous year. So the money supply, the M3 has grown by 11.2% as compared to the 9% at the end of the March 2024. Okay, mainly by the time deposits, because the time deposits has grown by a lot. The FD, the RD, they have grown by a lot. They have increased by a lot due to the higher deposit rates, because of the higher deposit rate, because of the higher interest. So repo rate is at a high percentage. So when the repo rate is at a high percentage, when the lending rates are at the high percentage, the deposit rates are also at a high percentage. So because of the high deposit rates, because of the high interest rates in the deposits, there is the higher deposits that is happening, and that money is being used by the banks to further lend and to further create the money. So the money supply has increased by 11.2%. The sustained demand for bank credit also exerted pressures for the banks to mobilize the more deposits. So this is also the reason that the deposits increased, because the banks were mobilizing more resources, because there was increased demand for the credit because of the good conditions in the economy. Okay. Now coming to the credit growth. So as per the Reserve Bank of India data that the RBI has released in its annual report, the double-digit growth in the bank credit has been seen. This was sustained during 2023-24, led by the demand from retail and services sector. So the credit growth has being in the double digits. So SCB's scheduled commercial banks credit expanded by 16.3% as on March 22, 2024 on top of 15% a year ago. So in the previous year also, in the previous financial year also, you can see that there was the double digit growth that was happening in the bank credit. In this year also, there is in the financial year of 23-24 that is ending in the March 2024, the double digit credit growth happened, and it was 16.3% for the scheduled commercial bank. For the different banks, you can see for the public sector banks, it is 14.7%. So the private sector banks, they are the ones that are doing more of that have seen even higher growth. So in the private sector banks, the credit growth has been even higher. Okay, so this is the main idea. Now, the private sector banks growth accelerated to 19.2% as on March 2024 from 17.8% a year ago. And the PSPs also have seen the growth in their credit growth, but it was not as high as the private sector. So I hope this is clear. Now coming to the next data point. So this is the sectoral credit growth that has been seen. So especially for the agriculture and allied sector, you can see that till the March 2024, the sectoral credit, the highest was going to the agriculture and the allied activities, and same is going, or the highest we can say was going to the services sector. Here it has been written now that the retail credit and the services sector credit was very high. So for the services sector, there was 20.2% of the credit that was going to the service sector, 20.1% of the credit was going to the allied and agriculture and allied sector, and here you can see that to the MSMEs, to the micro and small and medium enterprises, there was very high credit that was going to the micro, small and medium enterprises. So this is the sectoral data. You do not have to remember the data, but remember that to the services sector, there was the highest credit that was being lent. After that, there was the agriculture and allied activities, and there was very high credit that was lent to the MSMEs also, to the micro, small and medium enterprises. So now coming to the next point, that is central government finances in the 2023-24. So disinvestment receipts are the 30,000 crore in 23-24. So this much of the disinvestment receipts were seen. Okay. The interim union budget 2024-25 underscored the government's commitment. So interim union budget 2024-25. So in the union budget that was released for the 2024-25 in the February, this was not the complete union budget, it was the interim union budget because of the elections. So in the interim union budget 2024-25 underscored the government's commitment to fiscal consolidation, because here you can see that it has been said that we have to reduce the gross fiscal deficit from 6.4% to 5.1% in the 2024-25. So as per the budget estimates, there is the fiscal consolidation that has been seen. Like the government is moving towards the fiscal consolidation. That means the government is focusing on reducing the fiscal deficit. What is fiscal deficit? So fiscal deficit is the total expenditure. See, deficit is when your expenditure is greater than your receipts. You are receiving 10 rupees, you are spending 20 rupees. So there is the deficit that is happening. You are making the deficit because you are spending more than what you are earning. So fiscal deficit is total expenditure minus total receipts excluding borrowing. So fiscal deficit actually shows you that what is the total borrowing requirement because of your extra expenditure that you have done from your receipts. So it shows the total receipts excluding the borrowing. It shows the total expenditure. So let's say total expenditure is 20. Total receipts are 15. So that means total receipts excluding borrowing. So that means fiscal deficit is 5, and this fiscal deficit 5 is actually the total borrowing requirement, because how you are going to cover your extra expenditure? By borrowing, because it was excluding the borrowing. So if the fiscal deficit is being reduced by the government has given the expectation that we are going to reduce the fiscal deficit from 6.4% of the GDP to 5.9% in the 2023-24 to 5.1% of the GDP in 2024-25. So there is the fiscal consolidation. Even further reduction is going to come in the fiscal deficit. That means even further reduction is going to come in the borrowing requirement of the government. So this shows the commitment of the government for the fiscal consolidation, as well as the government is also promoting the higher capital expenditure, because capital expenditure means the assets will be developed in the country. So here the capital expenditure that was 2.7%. So capital expenditure that was 2.7% in 2022-23. So in the budget estimates and in the revised estimates, you can see that it was higher than the 2.7% in 2023-24, even higher. So the government has promised to do even higher of the capital expenditure, that is 3.4% of the GDP in the 2024-25. So this is the budget estimates as per the interim budget. Okay. So here you can see that the gross fiscal deficit declined to 5.9% of the GDP in the 2023-24 as per the revised estimates from the 6.4% of the GDP. Now the government is further promising and committing to even reduce the gross fiscal deficit to 5.1% in the 2024-25. Okay, remember this percentage, gross fiscal deficit, is one of the most important data that the government can release. Now, okay, so gross tax revenues increased to 11.7%. Gross tax revenues, here you can see it increased from the 11.3% in 2022-23 to 11.7% as per the revised estimates of the 2023-24, and it is further the gross tax revenues, it is expected that it will remain 11.7% in the 2024-25 also. So gross tax revenues increased to 11.7% in the 2023-24, their highest level since the 2008-2009, driven by the income tax collections. Okay, so this is the major data point. I hope you will read this carefully also, and you can see the data points that the capital expenditure, there is the commitment of the government to increase the capital expenditure and to decrease the revenue expenditure. So government is committed to reduce the revenue expenditure, because revenue expenditure is considered not good for the country. So government is committed towards reducing the revenue expenditure from 12.8% to 12%. It has as per the revised estimates of 2023-24 and 11.2% in the 2024-25. Capital expenditure is expected to increase, that you can see, to 3.4% of the GDP. So I hope this is clear. The union government's impetus to growth inducing capital spending is likely to be sustained in 2024-25. So the basic idea is that the government is focusing towards the capital expenditure. The government is focusing towards the capital expenditure, and especially the capital expenditure that is going to increase the assets in the country. So the capital expenditure is going to increase to 3.4% of the GDP. So remember this. Okay. Now this is given in the union budget, that you can see union budget document. As per the union budget document, the RBI annual report has also showcased this, that there is the ministry-wise division breakdown of the capital expenditure, so that you can see. So the highest is for the roads, yes, then it is for the railways, and so on and so forth. Okay. Next is the direct tax GDP ratio is projected at 6.7% of the GDP in 2024-25, or we can say the gross tax revenue, sorry, not gross, but here we are talking about the direct tax. So direct tax revenue as a percentage of GDP will be 6.7%, in the 2024-25. So this we had also discussed in the assessment wala part, that the direct tax as a percentage of GDP is projected at 6.7% of the GDP in 2024-25. So this is going to be good. So it will be the highest in 3 decades. Okay. So the non-tax receipts are budgeted to increase by 6.4%, while the disinvestment target has been set at 0.5 lakh crore for this time period of 2024-25. So this is the complete idea. Now coming to the state finances, we have understood the government expenditure, we have understood the central government finances. Now Rona, if you want to understand M1, M2, M3, M4, this is a static part, or I can take a separate session. Here if I keep on expanding everything, it will not end. Okay, or I can explain this to you in the revision session. For now, let's focus on the given points. Okay, that is important from the annual report. So state finances in 2023-24, states budgeted a combined gross fixed deficit of 3.5% of the 3.1% of the GDP. So here the gross fiscal deficit of the states is budgeted at 3.1% of the 3.1% of the GDP as the budget estimates of 2023-24. So for the 2023-24, as per the budget estimates of the state government, the fiscal deficit is budgeted at 3.1% of the GDP, and this is lower than the 3.5% of the limit that has been set by the center. On the receipts front, states overall tax revenue increased by 11.7% due to higher devolution from the central government. So central government provided a higher chunk of the tax revenue to the state governments. That's why they, on the receipts front, states overall tax revenue increased by 11.7% due to the higher provision of the central government to the state government, while own tax revenue growth has decreased. So state governments by themselves are not able to collect as much of the tax revenues. If you see the percent of GSDP means the gross state domestic product. So if you see the percentage of the gross fiscal deficit as a percentage of the gross state domestic product, so this is going to be 3.0%. Okay, so the fiscal deficit as a percentage of GDP for the states is going to be is said to be 3.1% for the 2023-24, but fiscal deficit for the 2023-24, but the fiscal deficit as a percentage of GSDP is going to be 3.3%. 3.3% for the 2023-24. Okay, and 3.0% for the 2024-25. For the 2024-25. So remember these data points, only these 3-4 data points are important from here, that the fiscal deficit as a percentage of GDP for the 2023-24 was shown as 3.1% of the GDP, but if you see as the GSDP, gross state domestic product, so it was 3.3% of the 2023-24 and of the GSDP, 3.3% of the GSDP for the 2023-24 and 3% of the GSDP for 2024-25. Any confusion till here? Now moving forward, external sector. So as I have told you that the export has declined. The export growth has declined as well as the import growth has declined. So exports have declined by 3.1% while the imports have declined by 5.7%. So there is higher decline in the imports as compared to the exports. That's why the current account deficit is happening, but that is lower. If you see that for the contribution of the sectors in the export growth, so the lowest contribution, or there is a negative contribution of the petroleum products, and there is the highest contribution of the electronic goods. Okay, so here services sector. So for the merchandise trade, we have seen that the exports have decelerated. They have fallen by 3.1%. The imports have fallen by 5.7% in the 2023-24. That is the financial year that we are studying. Okay. Now coming to the services. So services export growth has decelerated. That you can understand that the services were growing in the 2022-23. The services were growing by 29.6%. But now the services are still growing, but they are growing by only 5.5%. So the services export growth has decelerated in 2023-24 due to the weakening global demand for the services also. India retained its position in the top 5 exporting countries during the 2023. So top 5: Japan, UK, US, EU and India. Okay. So it has remained in top 5. Now coming to the remittances. So in the current account, I have told you that there are 3 accounts. We have discussed about the merchandise or the trade in goods, that the exports decreased but the imports decreased further. For the services, we have understood that the services has increased but it is lower, the growth is lower than the previous year. So the services export growth is happening, but it is only happening by 5.5% as compared to the previous year. Now coming to the remittances. So Indian remittances, that is transfer payments. Now coming to the third area, that is transfer payments. So inward remittances, that means the remittances that are coming in the country, that is the inward remittances to India, stood at $86.7 billion in 2023-24. India remains the highest remittance receiving economy globally. According to the World Bank, India's inward remittances are, India's inward remittances are estimated at $135 billion in the coming year, that is 2024, with a share of 15.2% in the global remittances. So you can understand that we are one of the highest remittance taking country in the world. So that you can see. For 2024 forecast, this is the forecast. In 2023, you can see we have received the highest of the remittances. Okay. So that is, you can understand the inward remittances were very high. That's why the transfer payments were good for our country. Okay. So now India's current account deficit narrowed because of there was the deficit that was happening in the trade in goods. There is the decline that has happened. So, but in the services, there is the growth that is happening. In the transfer payments, that is remittances, also we are having good transfer payments, but still the current account deficit happened because of the merchandise trade. It was 1.2% of the GDP in 2023-24. That was lower than the 2.6% of the GDP in 2022-23 from April to December data that we are taking. Okay, so that is what we have already discussed, that the India's current account deficit narrowed in 2023-24, okay, to $31 billion, that is 1.2% of the GDP, from $65.6 billion, that was 2.6% of the GDP in the April to December time period. Now coming to the net FDI. So net FDI means the inward FDI minus the outward FDI. So inward FDI, that was the gross inflows that were happening. Now see, Net FDI means the FDI that is coming in minus the FDI that is going out. So the inward FDI, now here the gross inflows that is happening, from this we have to deduct the money. Like let's say Apple store has been opened in our country, but after 1 month they are selling their store and they are taking the money back to their country. So that is repatriation, or that is the disinvestment that happened in the country for the FDI. Okay, so that's why here you have the net inward FDI. The FDI came in the country, that was gross inflows were 71. So gross inflows were $71 billion. But from this we have to deduct the disinvestment that was done by the foreign investors. So this investment was of $44.4 billion. So gross inflows were $71 billion, but from this the disinvestment, that is they are disinvesting in our country and they are taking back their money. So that was $44.4 billion. Okay, then there was so this much was the net FDI is the money that is coming in minus the money that is going out. So that was also 16.0. So in total, the net FDI was $10.6 billion. Okay, that was lesser than the $28 billion of the previous year. So net FDI, that is the FDI that is inward minus the FDI that is outward. So flows fell to US dollar $10.6 billion from the US dollar $28 billion a year ago, while gross inflows by the non-residents. So gross inflows means all the investment that is coming into our country, okay, all the money that is coming into our country from the foreign investors, from the foreign depositors. They are depositing in our country in the NRO, in the non-resident ordinary account, in the non-resident external account, in the FCNR accounts. So they are depositing also. So while gross inflows by the non-residents remained resilient, repatriation or disinvestment of FDI in India increased. So that became a major problem, that disinvestment happened of the foreign direct investment. So the inflow that came in, from that inflow there was also the disinvestment that was happening. Net inflows under non-resident deposits surged. So non-residents, they deposited in our country, NRO account, NRE account surged to US dollar 14.7 billions from the US dollar 9 billions a year ago. So that is the whole idea of the net FDI. The net FDI data is most important, that you can remember. The breakdown, this is not very important. Okay. Now coming to the source country wise inflow of FDI. So highest of the FDI were coming from Singapore, Mauritius, US, Netherlands and Japan. So during 2023-24, the top FDI source countries were Singapore, Mauritius, US, Netherlands and Japan. Their contribution was 73.9% in our country. Now outward FDI that happened from our country, so till previous year $14 billion were being invested in the other countries. Now we did the $16 billion of investment in other countries. So outward FDI from India increased by 13.9% during 2023-24 on a year-on-year basis. Singapore, US, UAE, UK and the Netherlands were the major destinations where the Indian investors invested in. Okay. Now the external commercial borrowings. So as I've told you that in the capital account, there is the investment that we take into account. There is also the external commercial borrowings that is happening, external assistance that is happening. So external commercial borrowing flows exhibited a turnaround during the 2022-23. There was the negative external commercial borrowings. That means we were borrowing lesser than what we were lending. So during 2022-23 we were borrowing lesser, we were lending more. But in this year we have borrowed more and we have lent less. So that's why there is a positive 3.5. Okay. So ECB flow exhibited a turnaround during the 2023-24 with a net inflow. So inflow was more in US dollar 3.5 billion as compared to net outflow of US dollar 4.1 billion in a year ago. So how much is coming in minus how much is going out, that we can understand. At end December 2023, India's external debt increased by US dollar 23.9 billion over its levels at end March 2023. However, as a ratio to GDP, it had declined. So even though in numbers you can understand that the external debt is increasing, but if you see it is as a ratio of GDP. So debt to GDP is actually declining. So that is good for our country and it has remained the lowest among the emerging market peers. So this is something that is important that you can write in your answer writing. Even if you do not remember the data points, you can write that as a ratio to the debt as a ratio to GDP has declined and remained the lowest among the emerging market peers as per the RBI annual report. Okay. So now we are done with the part 1. We are done with the part 1. We are starting with the part 2. So part 1 was the one where there were many data points. The part 2 is like that can be done in a fast manner. ECB's external commercial borrowings. Okay. External commercial borrowings. So we are borrowing from outside, as well as in this we can lend to outside also. So that is allowed. Any confusion here? Say yes or no, so that we can move to the part 2. If there is any confusion. Let's move to the part 2, okay? So we are starting with the part 2. We are starting with the working and operation of the Reserve Bank of India. So one of the most important function of the Reserve Bank of India is the monetary policy operations, okay? Monetary policy operations. Now only 2-3 people are able to understand. There are nearly 90 people in the session, right? What about the others? Only 10 people out of 90 people? Okay, so with the cumulative, so monetary policy operations, let's continue with this. So with the cumulative interest rate increase of 250 basis points, so by 0.25%, there was the increase that happened, sorry, by 2.5%, there was the increase that happened in the 2022-23. So in 2022-23, there was the increase from 4% of the repo rate to 6.5% of the repo rate. So in the 22-23, there was the 250 basis point or 2.5% of the increase that was seen in the repo rate. Now in 2023-24, there was the no increase that was seen. So in this financial year, there was the repo rate that was kept at 6.5%. So there was no increase that was done in the repo rate because the conditions were normalizing, as well as what was happening that this increase in the repo rate was transmitting to the country slowly and slowly. So in the 2022-23, the increase happened of the repo rate, but it was slowly transmitting, it was slowly passing down to the economy. That's why the RBI said that we will see that how it is transmitting to the economy, what effect it will bring in the economy, and for now we are not increasing the repo rate even further. So this was the complete idea, okay? So in 2023-24, there was no increase that happened in the repo rate, okay? The repo rate kept unchanged. Now, the external benchmark based lending rates. So first of all, see, the idea is before there was the base rate. Then later on MCLR came, then later on EBLR came. Base rate, see, RBI wants, if RBI is increasing the repo rate, if RBI is increasing the repo rate or if RBI is decreasing the repo rate, RBI wants the interest rate in the economy, to follow the changes in the repo rate. So RBI said that, okay, we will have a base rate, okay, below which the banks will have to, in the base rate, there was the indicative formula that was given by the Reserve Bank of India. This was the indicative formula. So the banks, they were not able to, they had to tell their minimum interest rate below which they will not be able to lend to any of the entity. Okay, but this base rate, because there was only the indicative formula that was given by the Reserve Bank of India, so various banks were following different minimum rates. They were coming out with the base rates in different ways, due to which the base rate, that was the benchmark rate at that time, was not actually following the shifts or the movements in the repo rate. So even if the RBI is increasing the repo rate, the interest rate was not increasing in the country because the base rate was not a very good benchmark at that time, and the different banks were coming as per their profitability, they were coming with the base rate as per their norms. Now MCLR, so in this, so the RBI shifted from the base rate to MCLR. RBI said that now the banks will follow the MCLR, that is the marginal cost of lending, okay? So marginal cost of funds based lending rate. So RBI said that now let's start with the MCLR. So MCLR, here the prescribed formula was given by the Reserve Bank of India that all the banks have to follow this formula. It is not indicative, it is prescribed. You have to follow this formula. But here in this formula also, the cost, the marginal, the additional cost of funds. That is, what is the cost of funds? What is the cost of funds? So cost of funds, let's say that banks are getting the funds by through the deposits. Now the deposits rates are very low. The banks also get the funds from the repo operation by taking the loan, by repo operation by taking the loan. Okay, so that is also a way. So marginal cost of funds. So usually the banks were following the deposit rate instead of the repo rate. The banks were following the deposit rates, that okay, their deposit rates are low, so their cost of fund is low, so we will follow the deposit rate. Again, this kind of formula was not good, because it was a prescribed formula that all the banks had to follow, but all the banks were like, their marginal cost of funding especially depended on their deposit rate that used to be very low. So the banks were not, like the MCLR was not able to follow the repo rate. Now the RBI said that now we will have the external benchmark lending rate, that RBI itself said that you have to follow the repo rate. So repo rate is one of the benchmarks. Other benchmarks are the yield, government security yield, or the T-bills, the yield of the T-bills. So yield of the T-bills move with the repo rate. So if the repo rate are increasing, the yield of the T-bills will also increase. If the repo rate is decreasing, so the yield of the T-bills will also decrease. So the RBI said that you have to follow any one of the external benchmark. It can be repo rate, it can be the T-bill, the yield of the T-bill, or it can be any of the rate that is prescribed by the Financial Benchmark of India Limited. Okay, so that is the name. Yes. So this is the basic idea. Okay, this is the basic idea that EBLR. Now the RBI has brought the EBLR, that is, you have to, like, there were the retail loans, the MSME loans, for that you have to follow any of the benchmark. Either it can be the repo rate, or it can be the yield of the T-bills, or it can be any of the rate that is prescribed by the Financial Benchmark India Private Limited. Okay, so this is the idea. Now other than this, for sure, repo rate, you have to move as per the repo rate. If repo rate is increasing, you have to increase your rates. And there was the timeline that was given, that in 3 months you have to change your rates as per the change in the repo rate. Okay, as well as, again, other than the repo rate, you can add your operating cost, you can add your other cost, you can add your margins also, you can add your spread also, as per the credit rating of the borrower. But repo rate should be some benchmark. Other than that, you can charge extra also. Okay, but repo rate should be the benchmark, or T-bill yield, or the any other rate as specified by the entity. So that's why we moved from the MCLR to the EBLR. Now what has been said, that the external benchmark regime introduced in October 2019 for the loan pricing in select sectors. It was introduced for the selected sectors, only T-bills. So external benchmark regime introduced in October 2019 for loan pricing in select sectors has strengthened the pace of the monetary transmission, because there has been the specific idea by the Reserve Bank of India that you have to follow any of these, as well as you can have the spread also of your interest rate, as well as you can add some extra cost, but the transmission should happen within 3 months. That means if RBI has increased the repo rate, you have to act as per the benchmark rate. If the RBI has decreased the repo rate, you have to act as per the benchmark rate, and this transmission should be seen in 3 months. So RBI has got a little more stricter to see the transmission of the change in the repo rate, in the interest rate in the country. Okay, so you can see that the monetary transmission has increased, the pace has increased to the lending rates, and the proportion of outstanding floating rate loans linked to the external benchmark. So floating rate loans, that is, there are the fixed rate loans. Now, if the RBI is increasing the repo rate, it cannot change the fixed rates because they are fixed. It can only change the floating rates. So, the floating rate loans linked to the external benchmarks increased from 44% as in March 2022 to 56.2% in December 2023. So, you can understand that there is more of the transmission, there is more of the utilization that is happening of the EBLR, as well as there is smoother transmission from the repo rate to the interest rate in the economy. Okay, so here you can read about the MCLR, you can read about the base rate. So the base rate was introduced in July 2010 as a system wherein banks cannot lend below a minimum rate. The RBI gave an indicative formula that was not that was being followed by the banks in different manners. So it was not letting to the transmission of the monetary policy. Then there came the MCLR in 2016. This was the marginal cost of the funds based lending rate. So here the prescribed formula was given, that this formula you have to follow, but again the banks were not able to transmit the monetary policy changes. Then the EBLR was brought to have the transmission of the monetary policy. Now in the incremental cash reserve ratio was applied as a temporary measure by the Reserve Bank of India during August 12 to October 7 to 2023. So see, the CRR is 4.5% in our country, that the banks have to keep 4.5% of their net demand and time liabilities, that is their net demand and time deposits. 4.5% of this the banks have to keep with the Reserve Bank of India. Now RBI said that for this time period you have to maintain extra 10% of your NDTL with the Reserve Bank of India. So this incremental CRR was brought because at that time the RBI said that there will be withdrawal of rupees 2000 notes that will happen. RBI had given this announcement that in May 2023, RBI said that start withdrawing the rupees 2000 notes from the economy. That means these rupees 2000 notes will go to the bank. Bank will have higher money supply. The rupees 2000 notes started flowing from the economy, from the people to the banks. So banks had higher money supply. So the banks will lend more also. So to reduce this kind of sudden money supply increase in the economy, there was the idea that was taken that we will have the incremental CRR. So the incremental CRR was reviewed on September 8, 2023 and discontinued in a phased manner. Okay. This incremental CRR was brought so that there is no sudden shocks and money market changes is being brought in a sudden manner. That there is suddenly very much increase that is coming in the lending done by the banks, the short-term lending, because the 2000 rupees notes are coming to the banks. Now they can lend for 1 day, for the 7 days, for the 3 days. They can do the short-term lending to the other banks, to the retailers also. So not such things should not happen that suddenly there is boom that is coming in the lending rate, there is boom that is coming in lending. So to stop that, this was brought. Okay, that incremental CRR will be 10%. Okay, later on, slowly the money supply was returned, because this rupees 2000 has to be returned to the public now, because like rupees 2000 has been taken. So 500 rupees in the 100 rupees notes, the money has to be returned. So slowly the incremental CRR was returned in the market also, with the banking system. So incremental CRR was brought so that there is not sudden increase in the lending. Slowly the money was returned to the banks. That was the incremental CRR. So this was the idea that was of the Reserve Bank of India. So the Reserve Bank of India has given the agenda for this was done in 2023-24. So for 2024-25, the Reserve Bank of India has given the agenda that we will be strengthening further the analysis of the transmission of our policy impulses. So if we are increasing the repo rate, so this should be transferred to the NBFCs also. So NBFCs, like only the banks are having the external benchmark linked rate. So NBFCs, we are thinking of bringing some transmission policy for the NBFCs also. Measuring the sectoral credit flows of the NBFCs, and there are different, you can see different measures that will be taken by the Reserve Bank of India in 24-25. Now credit delivery and financial inclusion. Okay, so NSFI, we will understand about this. First of all, let's start with the credit delivery, then we can start with the financial inclusion. I have provided you this so that you can read that what is the basic idea. Okay, now starting with the credit delivery. So achievement of the priority sector lending has been done. So you can see that in 2023-24, like scheduled commercial banks that have to give 40% of their A and BC, that is their adjusted net bank credit. From that, 40% has to be given to the priority sectors. So even more than 40% were given to the priority sector, that is 45.1% of the scheduled commercial banks gave 45.1% of the A and BC to the priority sector. In this, the private sector banks have done nearly 48.1%. Okay, that means 48.1 more than. So they have to do 40%, but the private sector has done 48.1% of the lending to the priority sector. The public sector has done 43.4% to the priority sector. So this is the idea, okay. On a year-on-year basis, the outstanding credit to the MSMEs by the scheduled commercial bank expanded by 20.9% during the 2023-24. So that was also good because the expansion is happening to the lending to the MSMEs, which is one of the priority sector areas, okay. Next is KCC. So KCC scheme data was also released. So KCC is what? It is the Kisan credit card. So through that, the the farmers can take easy loans. They can take easy loans. So Kisan credit card is a single window facility that is provided for the working capital as well as investment credit to the farmers so that they can buy their tractors, they can buy their products that they want to buy for their farming activity, for the cultivation, animal husbandry and fisheries. So the number of operative KCC cards has increased by 5.4% and the outstanding amount has increased by 10.9%. So the outstanding amount has increased by 10.9% and the credit number of operative cards have increased by 5.4% as compared to the previous year. So this is all. You can see the data point, the PDF you will get. So you can see the data point, okay. Next is financial inclusion. So for the we have understood about the credit delivery. Now coming to the financial inclusion. So the lead bank responsibility. See, in the country, for the districts, there are lead banks that are chosen. So lead banks are chosen so that they can further the financial inclusion in the particular district. So let's say in the Jammu and Kashmir, there is Jammu and Kashmir that is Jammu and Kashmir Bank that is chosen as a lead bank. So it will be duty of the Jammu and Kashmir Bank to further the financial inclusion in the Jammu and Kashmir, to further to go to the far off areas also to provide the banking facilities, okay. So the assignment of lead bank responsibility to a designated bank in every district. So that is the assignment of lead bank responsibility, that in every district, the RBI wants that in every district there should be a lead bank that has the responsibility to further the financial inclusion in that area, okay. So as on March 31st, 2024, 12 public sector banks and 2 private sector banks have been assigned the lead bank responsibility covering 779 districts across the country. So see, now in the part 2, in the part 1, the data points that were provided, they were important. In the part 2, where we are studying about the working and operation of the Reserve Bank of India, here it is very important for the answer writing. For the financial inclusion, the financial education you will study, the financial literacy you will study. So they are important for your answer writing. So you can use these points for your preparation of the fodder material for your answer writing, okay. Next is universal access to financial services in every village. So providing banking access to every village within a 5-kilometer radius, hamlet of 5 or the hamlet of 500 households. That the banking service, let's say a bank has to be created in the area which has at least 500 households, or a bank or a like infrastructure has to be created for the banking services within the 5-kilometer radius. So after every 5 kilometers, at least a bank should be, or some kind of infrastructure for the banking services should be provided. So that is the idea. So hamlet of 500 households in hilly areas, or the 5-kilometer radius other than the hilly areas, okay. One of the key objective of the NSFI. So NSFI, that is the National Strategy for Financial Inclusion, that was prepared for 2019 to 2024. One of the main ideas, objectives of NSFI is that we have to provide the banking access to every village within a 5-kilometer radius, or for the hilly areas, hamlet of 500 households. The milestone has been fully achieved in 27 states and 8 union territories. So if you write this data point, if there is any question in financial inclusion and such, so you can write this data point, right? As on March 31st, 2024, 99.99% of identified villages or hamlets across the country have been covered. So that is a big thing that you can understand in the terms of the financial inclusion. Next is Antardrishti dashboard has been released for the financial inclusion. There is the financial inclusion index that is released every year, okay, to show that the financial inclusion, the increase in the financial inclusion. So financial inclusion index, that is a comprehensive indicator of financial inclusion across the country, registered a year-on-year growth of 6.6% to 60.1. That was the value of the index, 60.1 in March 2023. Now it has 3 main the index, the financial inclusion index, it has three main components. So who can tell me the components? Other than this, under the registry, that was a financial inclusion dashboard. This was launched in June 2023. Okay. Now, coming to the agenda for 2023-24. So the agenda was to set up the CFL, Center for Financial Literacy. So one of the agenda for the 2023-24 was to set up the CFL, that is the Center for Financial Literacy, in the remaining blocks so as to cover the entire country. So there are the Center for Financial Literacy that are being created in every block of the country. Working towards the deliverables of G20 Global Partnership for Financial Inclusion. So there is the G20 presidency that was with India, and under this the GPFI working group was created, and the RBI has provided a lot of inputs for the reports that have been created by this working group. So that is another task that has been done by the Reserve Bank of India. Yes, very good. Usage, quality and access. So financial inclusion index has three components, has three dimensions for measuring the financial inclusion, that is the usage, quality and access. Okay, so this is the idea. Now the CFL, you can see that the CFL, that is the Center for Financial Literacy projects, was scaled up to 2,421 CFLs covering 7,225 blocks as at the end of March 2024. So the pilot CFL project initiated in 2017 with the objective of exploring the innovative and participated approach to financial literacy. So there were the Center for Financial Literacy that were started to be built up in the areas, and this has gained transaction, this has gained popularity, and more of the CFLs were created. As a part of NSFI, it was seen that there is the expansion of the CFLs. Okay, and you can see that by the March 2024, by the end of the March 2024, there is 2,421 CFLs that have been established covering 7,225 blocks. That is again a achievement that has been gained. Okay, next is financial literacy. So there is NSFI, that is the National Strategy for Financial Inclusion. Then there is the NSFE. So NSFI was from the period of 2019 to 2024. There is NSFE, that is National Strategy for Financial Education. Okay, for financial education. So this was created for 2020 to 2025. It has 5 C's. That is, it prepares the content, developing the capacity among the intermediaries, leveraging the community-led model so that the community teach each other, adopting appropriate communication strategy and enhancing the collaboration. So there are 5 C's, that is content, capacity, community, collaboration and communication. So these are the 5 C's that are taken in the NSFE to further the financial inclusion in the country, and there are different steps that have been taken by the NSFE, okay, under the NSFE. So various financial literacy initiatives were taken for the school teachers, for the students, and the financial awareness campaigns were also taken. Training campaigns were also taken for the graduates and postgraduates. Okay, so this is the idea that you can read. Next is observing Financial Literacy Week. So it happens every year. We have discussed about the Financial Literacy Week also. So that is the theme of this year. Financial Literacy Week was Make a Right Start, Become Financially Smart. So this was the Financial Literacy Week of 2024. The theme of this Financial Literacy Week was Make a Right Start and Become Financially Smart. Now these are the agenda for the coming year that we have to prepare the NSFI, because it is going to end in 2024. From 2019, it is for the 2024. So we have to recreate, we have to make a new iteration for the NSFI. So for that, there is the preparation that has started. Okay, you can read more about it, but this is the basic idea. Now coming to the financial markets and foreign exchange management. Okay, yes, various things have been done. I have only brought some of the points. So inclusion of sovereign green bonds. So there is the fully accessible route in which there are the specified securities that are told by the Reserve Bank of India. So that is fully accessible to the foreign direct investors, okay, foreign portfolio investors. So now it has been said that the sovereign green bonds of the government have been included in the fully accessible route. So that means there is the list of specified securities that is released by the Reserve Bank of India under the FAR. In this, there is the addition of the sovereign green bonds so that we can have the further increase in the financial market, further involvement in the financial market. Second is that we have completed this. There were the directions that were released for the CP and for the NCDs. That is, there were the direction that was released in January 2024 for the commercial papers and the non-convertible debentures that have the maturity of 1 year. So there were the directions that were released for these for the clarity to have in the commercial papers and the non-convertible debentures. So this is in the financial market to bring more clarity. The RBI is bringing the directions to bring the more clarity for the investors. Now there was also the decision that was taken by the Reserve Bank of India that the banks and the financial institutions in our country that were following the LIBOR as a benchmark rate. So LIBOR is the London Interbank Offered Rate. So many of the banks and the financial institutions, they were using the LIBOR as a benchmark rate. So it was said by the Reserve Bank of India that you have to move away from the LIBOR because LIBOR is little problematic. There was the setting of the LIBOR as per the some of the top financial institutions in the world. They were setting the LIBOR as per their willingness, as per their own corruption, or we can say as per their own motives, they were setting the LIBOR. So the RBI said that you have the banks and the financial institutions in our country have to move away from the LIBOR, and yes, we have to move towards the SOFR. And there were other benchmark rates also that RBI said that you can follow the other benchmark rates but move away from LIBOR. It is becoming problematic. So with the cessation of the publication of all the LIBOR settings after June 30, 2023, the RBI said issued a final advisory in May 2023 that advised the banks to stop, that advised the financial institutions to stop using the LIBOR. Or in the India, we have another rate that is connected with the LIBOR, that is the Mumbai Interbank Forward Outright Rate. So we have to stop using that. Other than this, we can use the SOFR. Now the SOFR, this is linked to the changes in the rate as per the Federal Reserve of the US. So US has the Federal Reserve, the monetary authority, as per their overnight lending rates, the SOFR is decided. So this is more like trustworthy, we can say, other than the LIBOR. So LIBOR stopped, MIFOR stopped. India said, RBI said that we can use SOFR or any other benchmark rate that you can use, and there was the modified MIFOR that was developed to replace the MIFOR. Okay. So this is the idea. Now Foreign Exchange Department has done various things. So one of that is to bring the AP Connect. AP Connect is the online application platform for the full-fledged money changers and the non-bank authorized dealer category 2. So the non-bank authorized dealer category 2, they are the authorized dealers that are able to convert the foreign currency into rupees and rupees into foreign currency. That means they can take into account the foreign exchange transactions. So they are allowed to do so, but they are the non-banks. Now for them, it was very hard to take the license. It was very hard to take the license. So the RBI said that we are preparing this AP Connect online application through which the full-fledged money changers, that are the individuals or the small units and the non-bank authorized dealer, they can send their forms, they can send their application through this online platform. Then there was also the levy of charges on forex, prepaid cards, store value cards. So if you are going to some other country, you want to have a prepaid card. Okay, in that prepaid card, like you will have $500 if you are going to US. Now the charges that were taken from you were taken in dollars or were taken in euro. So it was said that if in India the conversion of the money is happening, so the charges should be levied in rupees only. Charges should be levied in rupees only. So that was the idea. That levy of charges should happen only in India, only in the INR. So you should not charge in dollars, you should not charge in, like if you are charging the fees for the conversion of the rupees into dollars, you should not charge the fees in the other currencies. If it is being converted in India, you should charge in rupees only. Okay. Okay. So any confusion in India? LIBOR, I told you, LIBOR was connected. Sorry, MIFOR was connected. MIFOR was dependent on LIBOR. So if LIBOR is stopping, in the international level it is stopping. So we have to stop the MIFOR because MIFOR is connected with LIBOR. How the MIFOR will work when the LIBOR is not working, okay? Okay, so now remittances to IFSCs under LRS. So what happened? That, see, the liberalized remittance scheme. So if you are sending the money to the foreign, to some foreign country, okay, foreign jurisdiction. So if you are sending the money to the foreign jurisdiction, there are some norms that has to be followed. Okay. Now, if you are sending the money to the IFSCs, that is International Financial Service Center, that is considered a foreign jurisdiction. in like for the transactions. Okay, so if you are sending the money to the US, to the UK, to the Japan, so the norms that were under the liberalized remittance scheme were different for these foreign jurisdictions, and the norms were different in IFSC. So the RBI said that okay, we are making the norm same because the IFSC is also considered as the foreign jurisdiction for the transactions. Okay, so this is the whole idea that is being provided to you. So the resident individuals, the individuals in our country, the adults, the minor, they can send the money outside for their investment, for their various purposes. They can send the money outside in the other countries, and if they are maintaining the money in the other country, they are given the time period of 180 days, that for 180 days you can maintain the money outside in the foreign currency accounts. That means if you are taking the money to the other country, you have to use that for the investment purpose or for any other purpose. But if you are keeping that money only in the foreign currency account, in the international accounts, so you have to bring that back in 180 days. Because you are not using it, right? You are just keeping it in other countries. So why is it so? So if you are just keeping it, keeping the money that you are taking to the other country, if you are just keeping it in the foreign currency accounts, you have to bring it back within 180 days. But for the IFSC, it was written that if you are keeping the money in the IFSC in the foreign currency account, you have to bring it back within 15 days. So there was the discrimination that was happening with the IFSC. So RBI later on gave the complete guidelines that if under the liberalized remittance scheme, if the resident individuals are sending their money under the LRS to the IFSC and that money is being kept in the foreign currency account, the timeline is 180 days for that also, with effect from April 26, 2023. So the norms that were for the foreign jurisdictions, for the foreign countries, and the norms that are for the IFSC have been made same in terms of the LRS, especially the foreign currency accounts, the money that are kept in the foreign currency accounts. Okay. Next is regulation, supervision and financial stability. So you can understand that the Department of Regulation of the Reserve Bank of India, it regulates the regulated entities under the Reserve Bank of India, and again there are different norms that are brought by the Reserve Bank of India for the smooth working of the banks of the NBFCs. So there were the norms that were brought, like the fair lending practice that should happen. You should lend in a fair manner, the banks and the NBFCs. The credit investment concentration norms, credit risk transfer. So this was brought for the NBFCs to make the norms somewhat similar for the NBFC in the middle layer, in the base layer and in the upper layer. So to normalize the conditions, to normalize some of the rules for the NBFC upper layer and the NBFC middle and base layer, there was the norms that were brought by the RBI. Then there was the investment in AIFs. This kind of norm was also brought by the Reserve Bank of India that we have just discussed in the past 2-3 months, that the investment, if you are doing the investment in alternative investment fund, if the bank is doing the investment in the alternative investment fund, then there should not be the evergreening of loans that should happen. That means if the bank has given a debt to a person or to an entity, and the bank is doing the investment in the alternative investment fund, and through that alternative investment fund again the debt is given to that same entity, so that should not happen. Okay, so the norms were released. Fintech department works in the improvement of the fintech in our country. So here you can see that in 2023-24 the e-rupee retail pilot was released. So e-rupee is the CBDC, is the central bank digital currency that is just like the currency but in a digital format for the retail segment, for the normal consumers like you and me. So a pilot has been released in which there are some of the banks and some of the customers that are checking that how it works. Okay, so e-rupee pilot initially started with only 4 banks and 4 cities. Subsequently it was expanded to 15 banks and covered 81 locations, and now there has been the interoperability between the UPI and the CBDC that has been started, so that directly from the CBDC, directly from your bank, directly from your wallet. CBDC is not like, see, like if you have any money. Right now I have 500 rupee note, 200 rupee note, 300 rupee note, 10 rupee note. So that is not in my bank account, right? So CBDC is same. It is not in your bank account. You are just keeping it with yourself. So using the CBDC wallet, like you have the physical wallet. Similarly, you have the CBDC wallet. Using that wallet directly, you can pay through the UPI QR codes also. Even when you do not have the money in your bank account, you have the money in the wallets. I hope this is understandable. UPI can be done when you have money in your bank account. CBDC can be used even without the money in the bank account. Okay, so that's the idea. But CBDC, you can do the transactions using the money in the CBDC wallet using the UPI QR code. So there is the interoperability that has been started. And then there are various things that have been done by the fintech department. One of such thing is the second edition of the Harbinger hackathon. That was also brought. Okay, so Harbinger hackathon, recently the RBI is going to bring the third one also, so we are going to discuss that in detail. But there are the problem statements that are given that we have to do the innovation in this problem statement, so that happens under the Harbinger. Okay, next is Financial Stability Department, so that releases the FSR. So Financial Stability Department has the main task to look after the financial stability of the country and to monitor the financial stability risk and to release the financial stability report. So this is one of the function of Financial Stability Department. Number of bank frauds are also so the Department of Supervision releases this kind of data. Okay, so here you can see that in the number of frauds, they have actually increased. So the number of frauds that are happening have actually increased, but the amount of frauds have actually decreased. So this is one thing that you have to remember, that the number of frauds have increased, but there are smaller frauds that are happening as compared to the previous year, because the amount of fraud has actually decreased. Now, if we compare the private sector with the public sector, that is what we do. So we compare the public sector with the private sector. So in the public sector, the number of frauds have increased, the amount of frauds have decreased. In the private sector, the number of frauds is immense. So in the private sector, the problem is in the number of frauds. So if you have the account in the private sector, number of frauds are higher there. But let me tell you that the amount of frauds is lower in the private sector bank. So even if the theft is happening, that is of lower amount. Okay, so this is the idea. So there was a 46.7% decline in the amount involved in the frauds as compared to the previous year. So the amount of the frauds have decreased, but the number of frauds have increased. So this is the idea. Now the fraud cases came mostly from the card and internet. So number of frauds are mainly from the card and internet that is happening. Okay, yes, so the number of frauds are mainly from the card or internet, but the amount of frauds are highest from the advances that are given. Okay, so frauds have occurred predominantly in the category of digital payments such as card or internet in terms of number, but in terms of volume, the frauds are happening in the category of advances. Okay, now CEPD, so that is Consumer Education and Protection Department, it educates the consumers, it protects the consumers. So the Reserve Bank Integrated Ombudsman Scheme comes under the Consumer Education and Protection Department, because this is the one that is protecting the consumers, that is hearing the problem of the consumers. I hope this is clear. Public debt management. So the government of India, so the central government releases the central government securities are being issued by the Reserve Bank of India, so that the government can get the money, right? So the gross and net market borrowings of the government of India through dated government securities, that is long-term government securities, were higher by 8.6% and 6.5% respectively as compared to the previous year. So gross market borrowings were higher by 8.6% as compared to the previous year, and the net market borrowings were higher by 6.5% as compared to the previous year. You do not have to remember the numbers, but remember the gross market borrowings are higher because this is the money that is used for the expenditure as well as for the repayment of loans, while in the net market borrowings, we are only seeing the money that the borrowing that the government is doing for the recent expenditure. Okay, any confusion here in the gross market borrowing and net market borrowing? So the point that you have to remember here is that the commercial banks remained the largest holders of the government securities, including the T-bills and the state government securities, accounting for 37.6% as at the end of March 2024, followed by the insurance companies, followed by the provident funds and such. So here, what you have to remember that the commercial banks are the highest holders of the government securities, followed by the insurance companies and such. Percentages are not very important from here, but the basic idea is important, okay? Now, an ultra-long 50-year government security was introduced to cater to the demand from the long-term investors. So, this has been introduced in this financial year of 2023-24. So, this is some new point. Now, currency management. This is important. Here, the data has to be remembered. So, here, the data is not important, but in the currency management, the data is important. So, we have only 2-3 slides that are left. So, after that, the session will be ended, okay? So here, let's focus on this. So currency management. In the 2023-24, as I have told you that in May 2023, the Reserve Bank of India decided to take the rupee 2000 notes back, because the rupee 2000 notes, they are very big value notes that can increase the problems in the country. We do not want to have such big notes because they can be used for the purpose of the black marketing and for keeping the notes as a black money and such. So the RBI wanted to decrease the such huge value notes. So in May 2023, the RBI said that the rupees 2000 will remain legal tender, but we are taking it back. We are withdrawing it from circulation. So everyone that has the rupees 2000 notes, kindly return it to the banks. Okay, so that's why the banks started to get a lot of rupees 2000 notes. Now, why the RBI introduced the incremental CRR? Because of the banks getting too much of the rupees 2000 notes, so it increases the money supply with the banks, and the banks will start lending this money out. So RBI didn't want that. That's why the incremental CRR was introduced. I hope you remember this, okay? Now, rupees 2000 notes started to be withdrawn by the Reserve Bank, by the banks. So RBI said that kindly withdraw, kindly give back the rupees 2000 notes to the banks, okay? So this was one of the exercise that was done during the 2023-24 financial year. Now the value and volume of banknotes in circulation has increased by 3.9% and 7.8%. As compared to the previous year, the increase was 7.8% and 4.4%. So one thing that you have to understand from here is that, see, in the previous year, the value of the notes or the value of the banknotes in circulation was higher. So in the previous year, the value of the banknotes were growing by 7.8%. But now the banknotes, the value of the banknotes in circulation is only growing by 3.9%. That means the banknotes, they are growing in the country in circulation, but they are growing at a lesser percentage, okay? Now, the second point that here you have to understand is that the volume of banknotes have increased by 7.8% in this financial year as compared to 4.4% in the previous financial year, because in the previous financial year, the banknotes in the 2022-23, the banknotes were also in the 2000 rupee format. But now in 2023-24, the banknotes are usually in the format of 500, 100, 200 notes, right? So that's why higher volume is required to cover up the banknotes, okay? So before, only one 2000 rupee note had to be printed, but now 4 rupee 500 note had to be released in the economy to cover that one note. 4 notes have to be released. So that's why the volume is increasing by a higher amount to cover that withdrawal of rupees 2000. I hope this is understandable, okay? Now, total banknotes in circulation in terms of value is 34,77,805 as on March 2024, okay? At the end of the March 2024, the share of 500 banknotes in the total volume, the highest, in the volume, in the value, the highest share was of the rupees 500 notes as compared to the previous year. So at the end of March 2024, the share of 500 banknotes in the total volume was 41%, and in the total value was 86.5% in terms that was highest. Here you can see that the number of counterfeit notes that were detected, so that has gone down from 2,25,769 to 2,22,639. So the counterfeit notes have gone down, that you can understand in numbers, okay? That is the complete idea here. So, and the e-rupee in circulation at the end of March 2024 was 234.04 crore in value. So this was the e-rupee retail currency that was in circulation. Now coming to the payment and settlement system and information technology. So this is the last 2-3 slides that we have to do. Okay. So here the payment and settlement systems recorded a growth of 44% in terms. Now, when we talk about the payment and settlement, so this is the payment category. We are making the payments in the form of RTGS, NEFT, AEPS, UPI, the prepaid payment wallets that we have, the paper currency that we have, paper based instruments that we have. Paper currency is different, that cannot come in this. Now the settlement is also happening through the CCIL operator systems. The settlement is happening of the trading units. So payment and settlement systems recorded a growth of 44%. So this total payment and settlement system has recorded a growth. So there are various numbers that are given here. So that is not required. That's why I have only brought this for you to understand that what is payment system, what is the digital payment, that we will understand. Okay. So the payment and settlement systems recorded a growth of 44% in terms of transaction volume during 2023-24 on top of the expansion of 57.8% in the previous year. In the previous year, 2022-23, there was the increase in the payments and settlement system by 57.8%. Now in this year, further growth that has happened in the payment and settlement system, that is of 44%. So that is a great thing. In value terms, so this is in volume terms. In value terms, the growth was 15.8% in this financial year of 2023-24 against 19.2% in the previous year, with moderation in growth rate of both retail and large value payment system. See, large value payment system is known as RTGS. So whenever we say that there is the growth in large value payment system, so that is RTGS. When we say that there is the growth in the value and volume of the retail payments, so these are the retail payments. Okay, so total retail payments are 2 to 6. The total large payments are RTGS only. Digital payments, so usually you get confused in the digital payments and the retail payments. So retail payments under the payment and settlement systems, the retail payments are this. Okay, the digital payments are this. So in the digital payment, the paper-based instrument cannot come, right? So that is the difference that you need to understand, that retail payments are the small payments that are happening 2 to 6. The digital payments are from 1 to 5. The large payment, if you talk about the large payment, so that is only RTGS, okay? So that you have to remember. So retail and large payments, the growth has been moderated. Among the digital modes of payments, the RTGS transactions increased by 11.3% in the 2023-24 in volume terms and 14% in value terms. The volume and value of retail transactions. Retail transactions means retail means small transactions, that is other than the large value. So that is increased by 44.1% and 20.1% respectively. So this is what we have completed. Now PIDF is what? It is the Payment Infrastructure Development Fund. Okay, so this Payment Infrastructure Development Fund is the fund of the Reserve Bank of India through which the RBI promotes the expansion of the POS machines, the expansion of the QR codes in the country. So the QR codes and the POS machines are provided in the subsidized rate to the new merchants. Okay, so that is the idea. So here you can understand that through this fund, the RBI is promoting the deployment of the POS and the QR codes at the subsidized rates. So now there is the increase that has happened in the promotion. Okay, as well as there is the Aadhaar enabled biometric devices that are also being provided, as well as other contemporary and the new devices are also being provided other than the swiping machines and the QR codes. There are the new devices that are being provided that tell you that okay, QR code is simply the QR code, right? You are paying, there is no announcement. But in the like in the contemporary devices, there are the sound box devices. If you scan the QR code, they also tell that how much rupee has been received. So contemporary devices are also being spread. Okay, so the numbers of POS terminals increased by 14.3%. So the number of POS terminals increased by 14.3%, and the number of Bharat QR codes employed increased by 16.1%. Okay, now UPI QR codes increased by 35% to 34.6 crore at the end of March 2024. So this is like when we talk about the Bharat QR codes, so they are the increase that has happened under the PIDF. If we talk about the total QR codes in the country, so that has increased by 35%. Okay, so under the PIDF, under the scheme, there is the increase of the Bharat QR codes of 16.1%. If we talk about the total QR codes in the country, other than the PIDF scheme also, there is the increase of 35%. Any confusion here? So this is the last slide. Okay, we have to do the RBI accounts, then it is completed. Okay. So now, see, the Reserve Bank has done the Digital Payment Awareness Week. Okay, in the Digital Payment Awareness Week was conducted by the Reserve Bank of India. The Reserve Bank of India also released the Digital Payment Index, in which we have seen that the Digital Payment Index has actually improved. Okay, then there are different steps that were taken by the Reserve Bank of India in the payment and settlement category in 2023-24 that we have already discussed in the previous year. So this is just a revision kind of thing. That amendment was done on the PPIs, on the prepaid payment instrument. RBI said that we are going to bring and we are promoting the banks and the non-banks to bring a prepaid payment instrument for the mass transit, the traveling that the people do. For them, we have to bring a new PPI. The banks and the non-banks have to take this into account, that for the mass transit, there should be a PPI. Streamlining Bharat Bill Payment System. So Bharat Bill Payment System, we have discussed this in depth, that there was the complete guideline that was brought by the Bharat Bill Payment System by the RBI. So RBI had brought the complete guideline for the Bharat Bill Payment System. Inclusion of Pradhan Mantri Vishwakarma scheme. So Vishwakarma are the people that use their hands for the handicraft things, for the cobbler and blacksmith are these kind of peoples that are the Vishwakarma. So the Pradhan Mantri Vishwakarma scheme was integrated under the PIDF scheme, so that the Vishwakarma, like the blacksmiths and the cobblers, they also get the benefit of the subsidized POS machines and the QR codes under the PIDF scheme, so that these kind of POS machines and such are also available to the Vishwakarma people also. Okay, enhancing UPI transaction limit for the specified categories such as hospitals and education institutions from 1 lakh to 5 lakh. Global outreach of the payment system. So UPI and RuPay cards, recently RBI has done various collaborations with different countries. Okay, in this regards, Reserve Bank had constructed a composite digital payment index that you can see. In 2021, the TPI increased by 10.9% to 418.8 in September 2023 from the 377.5 in September 2022. Sorry. From here, we have reached to here. That is 10.9% of the improvement that has been seen. Okay. Now coming to the RBI account. So this is the last slide. Okay. So RBI account, we have already discussed that the RBI has transferred 2,10,873 lakh crores. So crores. 2.1 lakh crores, we can say 2.1 lakh crores, or we can say 2,10,873 crores. This much of the surplus has been transferred from the RBI to the government. Now the question of most of the students was why this has happened. Income has increased so much that there is huge increase in income of the RBI, that RBI was able to transfer such huge surplus to the government. And how the income has increased so much? So actually the income has not increased too much. Income has increased. That is general. Like if your salary was 50,000, now 10% hike is given. So your salary is 55,000. So that is the basic increase in income. So RBI also had the basic increase in income. If you see 2,35,457 to 2,75,572. Not much difference. 40,000 something crores have been changed only. The difference is in the expenditure. The expenditure decreased by a lot for the Reserve Bank of India. There was a huge decrease in expenditure of the Reserve Bank of India, due to which, so income of the Reserve Bank of India minus the expenditure of the Reserve Bank of India, that is the profit, the surplus that was transferred to the government of India. Expenditure of the Reserve Bank of India decreased a lot. So that was on account, because in the previous year, in the 2022-23, there was very much fluctuations that were coming in the sovereign bond yields of the foreign countries. So the RBI has purchased the foreign securities, okay, the foreign shares, the foreign bonds. In the foreign bonds, there was, like in the foreign securities, there was very much fluctuations that were coming. So RBI had to keep revaluation amount for those foreign securities that were having major losses. But in this year, as the sovereign bonds they are having the recovery, their yields are rising, so the RBI didn't have to keep the revaluation amount. So that's why in this year, so you can understand that in the previous year, because of the high fluctuation in the foreign securities prices, there was high fluctuation and the decrease in the foreign securities prices. Due to this, what was happening, that the RBI had to keep high provisions in the previous year. In this financial year, the foreign securities were not having so much of the dip. So the provisions that the RBI had to give were lesser, due to which the expenditure decreased by a lot. And if you deduct the income, expenditure from the income, you will see that 2,10,877 surplus was left with the RBI, from which surplus the RBI gave 1 crore to these 4 entities for these 4 funds, not entities, funds. So RBI gave 1 crore each to these 4 funds, and after that whatever surplus was left was given to this Government of India, was given to the Government of India. Okay. Now, as per the, so this is as per the economy. So as per the ECF, so we have discussed this. We have discussed this complete the surplus that has been transferred from the RBI to the Government of India. So under the ECF framework, it requires the contingent risk buffers to be maintained with the Reserve Bank of India. Okay, so that's why the risk provisions and the risk buffers have to be kept maintained. So in the expenditure of the RBI, there is already the inclusion of the risk buffers. So here you can understand that the RBI is getting the income from the interest that the RBI is earning from the foreign securities, if there is any profit that is coming and such from the foreign shares and such. So income of the RBI minus the expenditure. Now the expenditure includes the contingent risk buffers. Contingent risk buffers can be within the range of 5.5% of the balance sheet of the RBI or 6.5% of the balance sheet of the RBI. So RBI said that for the 2023-24, we are going to keep the highest of the contingent risk buffers because there is huge surplus. So we can keep this much of the buffers. So in 2023-24, the highest of the buffers, contingent risk buffers were kept by the Reserve Bank of India, that is 6.50%, that is higher than the previous year, that was 6%. Okay. So under the framework, it requires the contingent risk buffers to be maintained with the Reserve Bank of India. Even after maintaining the 6.5% of the risk buffers, the RBI was able to transfer so much of the money to the Government of India. Okay, total assets. Now, what is the balance sheet? What is the balance sheet? So, the balance sheet is that what is the total assets of the Reserve Bank of India. So, it is the total income. But what is the total assets? RBI has so much of the regional offices. RBI has so much of the income and such. So, total assets of the RBI is actually 70,47,703 crores. Income was 2 lakh something crores. Okay, the total assets are 70,47,703 crores of the assets the RBI has. 6.5% of the balance sheet of the total assets. So 6.5% of this balance sheet crore has to be maintained by the Reserve Bank of India. So I hope you understand now that the income for this period is this much, the expenditure for this period is this much, the available balance is this much, that is from this. If you deduct the 4 crores for the different 4 funds, then this is the surplus that is being transferred by the RBI to the Government of India. 6.5% of the contingent risk buffer, 6.5% of the balance sheet, that is total assets. Okay, so this is 6.5% of the total assets or 6.5% of the balance sheet. We can say this much of the contingent risk buffer the RBI is maintaining for the 2023-24. So that is 4,58,100.695 crores. So this is the total amount of the contingent risk buffer. I hope this is clear. Any confusion till here? Ma'am, please explain Spectra project. Where have you studied this? Any confusion? Yes, Shwetang, because they have the higher GDP, no? We have lower GDP, but still it is very if you see net worth of a single entity, so that is very, very good. Clear everything? Okay. So So if you go to the edutap.co.in, you can go to this website, and here in the free material the blogs are provided. So in the blogs there is the detailed analysis that has been done for the exam. So if you want to know about the exam information, job profile, if you want to know about the strategy, courses, the success stories, so everything is provided here. So if you go to any of the examination, you can know about the different details, okay, exam information about the exam, the success stories, how the people were able to achieve their dreams. And here at the end of the page there is the join our Telegram channel, so you can go and join so that you can get the PDF also. So I hope you like the session, and I hope you will read the blogs to have more detailed understanding of the examination. So this is the complete report. Now the revision session will be on Tuesday, where we will discuss that which data points are important and which data points you can leave. Thank you so much. Yes, it was a very lengthy process that had happened. I was working on this report for 2-3 days, and in the PPT format I had to put everything for you to understand everything better. I do not want to make it very cumbersome. So yes, it took a lot of efforts. I hope you really liked the session, and do tell me in the comment section also. And I'm thinking of bringing questions for the revision session. But do you want me to bring all the slides and just to tell you the data points? Do you want me to do that also? So you can tell in the comment section that you only want MCQs, or you want me to tell you the data points also. Okay, so you can tell me in the comment section. I hope you like the session. Thank you very much for joining the session, and you're most welcome, all of you. Thank you for joining the session. Do tell me in the comment section also, okay? So thank you so much for joining the session, everyone. It was wonderful. I was very worried about this report also, because like I had to take the long session. See, I wanted to take it in one session because you can stop the session and you can go work, you can go enjoy, you can do anything. But if you have to find the 2 sessions, that become cumbersome, that when the other session will be released, where is the link and everything. So it can become a little troublesome. Okay, so that's why I wanted to take it in one session, though it took more of my time. And I could have taken it in 2 sessions. I wouldn't have to make the PPT for next Wednesday, Thursday and so. But I wanted it to be easier for you, not for me. So I have brought this here, okay, in one session, so that it can be easier for you to find. So I hope you like the session. Okay, I hope I have been able to maintain my energy throughout the session. But still, if you find any point that you are not able to understand, feel free to write in the comment section. Feel free to discuss with me on Tuesday. That's why I am bringing the revision session on Tuesday, so that you can go through the session again if required. You can go through the PDF. If any point you are not able to understand, discuss with me on Tuesday. Okay, feel free to do that. You are most welcome. Thank you so much, and do tell me in the comment section also. I want to see all of your messages in the comment section. Thank you so much for joining the session. You're most welcome, everyone. Thank you so much. Do tell me in the comment section so that the team can also see, and I can also see the comments later on. Thank you very much. Thank you so much.